Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Ladies and gentlemen, thank you so much for joining RenCap's 12th Africa Conference. This one is focused mainly on sub-Saharan Africa. We've got 50 corporates, we've got over 100 investors, at least 250 meetings already set up. I hope you enjoy the next few days. And that you had a decent break at some point in August, because we're all going to have a fairly interesting few months ahead, I think, through to the end of the year. Right, what I'm going to do here is talk pretty fast, because my kids have been telling me that when it comes to watching stuff online, they've been speeding up all their teachers and professors by at least 50% or 100%. I don't want to put the effort on you to do that. So I'm going to speak fairly fast, and also because I've spoken to a fair number of these slides already. Firstly, what's happening for Sub-Sahara on growth? We've got a situation where obviously it's not quite as strong as the rest of the world in 2021, but that's because 2020 was a year of outperformance by Sub-Sahara, just as it had been in 2009. In 2009, because it was a global financial crash and Africa was less financialized, if you like. And this time, because the continent is younger and it just didn't suffer quite as much from the lockdowns where they happened in most cases. The youth story we've talked about before. We talked about it from February, March, I think last year, 2020. It continues to be a big reason why the COVID hasn't hit as badly, at least in terms of the health outcomes. There's a whole host of diseases which are still killing far, far more people than COVID is in Africa. And we're seeing, if I compare Nigeria to Brazil, interestingly, they're almost identical populations right now. Brazil is older. It got its fertility rate lower back in the 1980s. And Brazil's been getting, 80 to 100,000 new cases a day. Nigeria's only once, I think, popped over 2,000 a day. So a very different outcome. Obviously, there's less testing. What our Lagos office is telling us is that people are getting tested when they travel in Nigeria. They're getting tested when they're seriously ill, but otherwise not as much, perhaps. But nonetheless, this has meant that Nigeria's had an easier crisis, at least in GDP terms. Big picture story, and the big shift I still think is that US, Europe, Japan, their debt levels have jumped higher yet again, and that high debt is going to keep interest rates in developed markets extremely low for a very long time to come. If we go back to February, March this year, yes, I was worrying that my call of 0 to 2% US Treasuries through to 2030, that call wasn't going to even last 2021. But the way US Treasury yields have come back down in recent months continues to support that view. German bunds in red on this chart continuing to track Japan with about a 17-18 year lag. US a bit higher, but not able to break away too far from those German or Japanese bond yields. And the consequence of that, of course, being that investors continue to look for yield. And they're looking for yield in dollar debt first, and that's something we've seen in the flows over the last 12 months. And the yield then on emerging market dollar debt has been coming down to about 4%. We're at 3.8% last week. So my base case is that that's going to continue to lower gently through the decade. And as a result, sub-Saharan borrowers, so more frontier borrowers, are also going to be able to borrow at ever cheaper rates. There are going to be exceptions. I'm flagging here the chart that I might have been showing you actually first time back in November. It's been updated since then. There are countries where the interest payments as a percentage of government revenues are extremely high. I mean, over 60% in Sri Lanka's case. And where interest payments as a percentage of GDP are also extremely high. In Sri Lanka's case, over 6% of GDP. And Sri Lanka's Eurobonds are priced for default. Other countries which also look vulnerable, Egypt, Pakistan, Angola, do actually have IMF programs in place. And I think that's one of the key reasons why we're still recommending those bonds, but also why we haven't seen them priced to default. Lebanon's obviously run into trouble. Zambia, we'll get to a little bit later. My concern in the longer run is that countries that go out and borrow need to be borrowing in order to boost their export capacity. And what's happened over the last 10 years, I'm using 2019 data because 2020 is so distorted by the GDP hit. Between 2010 and 2019, you can see most countries in Africa saw a big increase in their debt to exports ratio, telling you that the borrowing didn't translate into higher export capacity, which will help them manage the debt. Now, thanks to globally falling interest rates over the last 10 years, that hasn't really mattered too much, except for a few countries. But it's going to matter over the next 5 to 10 years, unless the borrowing is used to boost that export capacity. And if we look at Asia, that's exactly what's happened in Asia. In the main, these ratios have not deteriorated dramatically in Asia. And you've got a country like Vietnam looking particularly good there on the right-hand side. Yes, there's been an increase in external borrowing, but export capacity has gone up way in excess of that. And as a result, their debt to exports ratio has got better. And that's why Vietnam is one of the most favored frontier markets. And the countries in trouble on the left, in Asia too, Lebanon in default, Sri Lanka threatened by default, Pakistan has to watch what it's doing carefully in the next few months. Now, my default worries, which obviously got greater in February, March, when Chad and Ethiopia and Zambia all looked to the G20 and said, we need a debt forgiveness. And the idea of this G20 debt forgiveness framework was that China would be involved, particularly important for a country like Zambia. Our concern was we were going to see a whole host of countries going down this route. Who was next was the concern, and Laos looked like one, Sri Lanka looked like another, and so on. Now, the SDR increase, the special drawing rights increase that came through in August, I think is taking the pressure off for at least 6 to 12 months, even maybe in Sri Lanka's case, but possibly for even 2 to 3 years. The emerging markets seeing big increases in their reserves as a result of this special drawings rights increase. China, obviously a massive $41 billion, South Africa, an extra $4 billion. And in Africa, we've had a very helpful boost to a great many countries. That's frontier, and if I show you Africa here, we've got North Africa on the right-hand side. So in all of these countries, reserves that will be showing up as slightly better figures for the end of August. And what we're going to hear in the next session from the head of the IMF Africa Department is the extent to which rich countries are going to take their allocation of special drawing rights, which I think in the US case is well over $100 billion on its own, and reallocate them too. And that does look like it's on the cards, although I think we'll struggle to pin down a date as to when these extra tens, maybe hundreds of billions could be coming to lower income countries. Certainly this is really helpful for now. So for now, the concerns about debt default, except where we're well down the road as we are in Zambia, I think are going to be considerably lessened. Big picture, this is the GDP map I'll have shown you a few times already, and also the look at how countries look in terms of democracies or autocracies based on Polity4's figures from a year or so ago. So there's been a couple of changes since. And in fact, on that front, this last few days, we've just had a coup announced in Guinea on the left-hand side of the map there in grey, and in grey because this is where adult literacy is sub 40%. Even today, just under 2/5 of adults can actually read or write in any language in Guinea, and also in Niger, Mali, Chad, South Sudan, Somalia, which happen to be a lot of the countries in trouble. In fact, we've had coups in Chad and Mali, as well as Guinea, just in the last few months. And I think that is going to continue to be a problem for the Sahel region. Afghanistan, where we've had the military takeover just recently, the figures there for literacy are about 42%. Not a huge surprise that we should be seeing ongoing conflicts and a great deal of instability. But the core point that I'm usually drawing out from this map is the green countries are where adult literacy is 70 to 80% or more, and that's enough to industrialize. That's a great story for North Africa, a great story for Southern Africa, if we get a couple of other things right too. But admittedly, this is going to be an ongoing problem for most of West Africa, with a notable exception of Ghana and Southern Nigeria. And then electricity is the next big issue. Again, I've been talking to you about this before. We did a big report in 2018. These data are a few years old now. They don't get updated very often, unfortunately. Again, Ghana comes out pretty well here. North Africa comes out well. Southern Africa could be doing well too. And there's the underlying issue that I've talked to you about of fertility rates. And the argument that we're putting across is that it's low fertility countries that have high domestic savings. Those high domestic savings keep interest rates low, and those low interest rates means you've got plenty of money for infrastructure spending, plenty of money for electricity, for example, which is why Morocco, Tunisia are all good on this front. South Africa, although South Africans would disagree with me, are looking pretty good on the electricity front compared to many other countries in sub-Sahara. What interests me here are the countries where we'll see a shift in the next 5 to 15 years. That's Egypt, Ethiopia, interestingly, Kenya, Ghana. They're the ones where we should see fertility rates dropping below 3 children per woman, and it tends to be when savings jump. So the bank lending story in Mauritius or Morocco or Tunisia, Egypt, South Africa, Egypt less so because they're not there yet, but the other countries already high because of this fertility rate story. And where fertility is too high, Angola, DRC, Nigeria, that's telling us that bank lending is going to continue to be small as a percentage of GDP. Also means the return on capital, of course, is extremely high because capital is so scarce in these countries, unless they're running a current account surplus. Capital is so scarce that it's very valuable. So it's possible to make very good returns, but it's not going to be countries where you're likely to see very high infrastructure spend, at least not without massively high commodity prices too. And then the other issue about fertility that I just need to reiterate, but speed me up to 50 to 100% if you've heard this before, is that countries where you've got roughly equal numbers of adults to kids, like a 1-for-1 ratio on the left-hand side, your per capita growth is 1.4% on average. That's looking at all countries in the world since 1960. It's an awful lot of data points. It's when you cut the number of kids down dramatically relative to adults, when you've got like 2.5 adults per child in your country, child or pensioner, but usually it'll be kids when we're talking about developing countries. That's when your per capita GDP growth takes off. That's when you start booming 3, 4, 5% per capita GDP growth. And you add in the population growth on top, and you start getting in these 6, 7, 8% numbers, which is so fantastic. Africa's problem has been that the fertility rates have been too high, which is why from 1960 on the left of this table, which you can't possibly read, I'm sorry, it's far too small, but you can read it in the presentation later, the growth rates haven't been good enough to lift most of the continent out of low income status. But it's changing. And based on UN forecasts now, which I do hope will be wrong, but based on what they're saying now, assuming fairly high fertility rates for years, at least another 10 years in many countries, you're going to see everybody looking much better by 2050, nearly everybody, but many countries already by 2030. So that's the big picture stuff that we've talked about. Where are we at on markets right now? Let's just focus on currencies. You know, I'm obsessed by them, particularly because if you're running a current account surplus, then all our worries about utility rates, low deposits, equals high interest rates. That gets invalidated if a country has a current account surplus. So that little box on the top right of that chart is telling you that if you're running a current account surplus, even if you've got a small banking system, you can have basically flat 0% real rates, minus 0.2, in fact, real rates, if you're running a current account surplus. So having a cheap currency is really quite helpful. Throw in euro dollar, not because I've got any sense of what it's going to do. I never know that. All I can say is that if we look at where the range has been trending for the last 6 months or so, somewhere between 117 and 124 would be my guess for the next 12 months, with a slight bias to dollar weakness. But I wouldn't hang many forecasts on that. What's more interesting is, or more useful, is our real effective exchange rate estimates. And the difficulty for Africa here would be the countries on the top half of this table, which are looking overvalued currencies over compared to their last 25 years, including Republic of Congo, Nigeria, Egypt, Kenya, Ethiopia, Zambia, and so on. And that is a problem, given our point that you need to be running a current account surplus to have low interest rates. If you're running an overvalued currency, it's going to make it harder to run that current account surplus. Zambia, of course, still can because copper prices are so insanely high. But it should be, countries lower down on this should be in a better place. Countries like Ghana, South Africa, actually, Angola, Rwanda, all looking pretty cheap, and I think quite interesting times to be getting involved. And then there's countries like Tunisia, which have been looking very cheap on this model for years now. But the underlying reality fully justifies it being this cheap. Tunisia shouldn't be running a current account deficit, with the IMF is saying, what, minus 9.5% of GDP in 2021. Shouldn't be running such a big deficit if there wasn't quite a lot wrong with the economy. How often are currencies here? So the one which is looking exceptionally good value right now, this is as of Monday morning, 6th of September, actually data, 20%, more than 20% cheap is Ghana. But to be fair, it has been more than 20% cheap 20% of the time. So it doesn't tell us we're going to get an instant bounce back. And that's true for quite a few of the countries, actually, which are looking 5 to 20% undervalued too. A lot of them have been this cheap for quite some time over the last 25 years. So there's no strongly compelling message here about which currencies are going to change dramatically in the near term. For Nigeria, this is a market which has actually been down a little bit in 2021 in dollar terms. The currency remains the stumbling block. We've got at least 2 estimates of fair value. Yvonne is likely to be talking about them at another session through the course of this week. If I had to guess where I think the currency ought to be, I would say a little bit weaker than 504 to the dollar would be appropriate. So we are looking overvalued. I wouldn't mind if that overvaluation was justified by a hefty current account surplus, like it is in Zambia's case, but it's not. So sooner or later, we'll have to see some adjustment on that. And the difficulty that portfolio investors have in terms of accessing the local market, getting money in and out, continues to be a problem for this market to perform. Tunisia, this is a country that I really hoped was going to come good in the 2020s. We wrote a piece back in 2018. It says all about the elections in 2019, 2020. If we see reformists coming to power, you could take this country in a brand new direction. It didn't happen. And the president who did win, who's no economist, has now closed down parliament, initially for 30 days as per the constitution. He's now indefinitely extended that. I haven't seen the constitutional provision that allows him to do that. We've got democracy perhaps on the way out as it stands. Awkward relations with the IMF. There was an attempt to try and rebuild them a few months ago. That the government was doing that. They've just been sacked. Eurobond prices are telling you that the markets are not very enthusiastic about where Tunisia is going. So it's a small market, and it's not doing itself any favors right now. Could that change? I mean, hopefully we get a strong government backed by a president who's prepared to take an awful lot of power under his wing. Maybe this will start to come good in a few months' time, but as of now, there's no strong reason to believe that. Morocco. Actually, Morocco is not only got elections this week, it's seeing a fantastic turn at last in the virus numbers after a heck of a rise over the last few months with the Delta variant, last couple of months. So tourism could be coming back. Car output remains a big issue, and globally we're seeing impediments and blockages and shutdowns. I haven't seen anything on that in Morocco. In fact, almost the opposite. We're seeing more factories coming to Morocco to support the supply chain. The industrialization story that we've been talking about from Morocco for years now is well in play. And this could be a very interesting recovery story. The shock of the last month or two to me has been Zambia, where an incumbent losing election, in fact, of course, has happened in Zambia. But this was really helpful, and you see it in a jump in the Eurobond price just in the last month or so. People are looking much more optimistically now about what the new businessman president can do. He wants an IMF deal. Copper prices are ballistically high. We're kind of at levels we saw in the 1970s as well as during the boom time of kind of the 2000s. And they've got great human capital. They've got loads of electricity. They even have a high investment to GDP ratio. There's an awful lot right about this country, which good leadership could turn into something good. We've also seen change in Tanzania, where Magufuli was, a mix of, is one way of putting it, of ideas. The bulldozer, as he was known, but his demise to COVID has left us with the vice president's been promoted into that job. She looks really interesting. She studied development economics, at least for a year, at a UK university. She's seems to be a steady pair of hands. She seems to be being more transparent about COVID. I genuinely very interested by where she can take this country. And in Congo, you might have looked at the towers business there over the last year or two. The president has been taking some of the power back, the official power he's been drawing into himself, which he should have had all along, but which a lot of the unofficial power, of course, was still with the old president. So there's been some shifts happening there too. So positive political change in quite a few of the major stories here in Central and Southern Africa. What else am I looking at? Occasionally a question comes up, what's happening in Zimbabwe? It's still a mess. Still a mix of certainly a political mess, efforts to try and control the currency, struggling. Much better story in Senegal and Cote d'Ivoire. You've had re-elected presidents who've already given us strong investment-led growth stories. How's that possible with their high fertility rates? It's possible, I think, thanks to the currency peg, which at least keep interest rates low, which is supportive of the investment story. And Senegal's got this whole oil story, which got delayed last year, but I think it's, from what I hear, is back on track, and we're going to see high investment and very, very high growth out of Senegal over the next 2 to 3 years. Rwanda's really interested me in the headlines for the last month or so. You've got this sending troops off to northern Mozambique, where you've got these kind of Muslim extremists who've been bringing the gas story to a halt. Rwanda's sending the troops down to try and sort that problem out, and also saying to an Afghan girls' boarding school, come to Rwanda for a term until Christmas, till December. Base yourselves here. And I think this is quite interesting. Foreign policy moves with Rwanda punching well above its weight. Egypt, main news that caught my attention in the last month or two was the Russians finally coming back to the tourist resorts. Flights got allowed back to Cairo some couple of years back already, but they weren't going to Sharm el-Sheikh, they weren't going to Hurghada, and now they are. And there was it 250,000 a month used to be going in 2014-15. It's like 20%, 25%, maybe in some years 30% of all tourists going to Egypt were Russian. So if the Russians are going to come back, and I suspect the COVID differential in numbers isn't going to be that much of an issue, this could be very helpful. Because if the tourism money starts to come back to Egypt, if the current account starts to improve because of that, the central bank doesn't need to keep encourage market interest rates to be quite so high. And if they don't need to do that, and interest rates come down, maybe local investors will say, oh, I quite like Egyptian equities instead of Egyptian bonds. Maybe banks could start lending again. Maybe that then tempts in some of the international investors to take another fresh look at Egypt. So quite a big deal. And this is going to be an interesting set of data, the Russian tourist numbers, over the next few months. And I have to end with Kenya. It's the best performing market in Africa in equity terms of the ones we've been talking about, up about 22% year to date. Morocco's about 10, Egypt's roughly flat, and Nigeria's down a few percent. This is despite the Kenyan shilling weakening off in the last month or two, which I assume is connected to poor tourism, high oil prices. Yvonne will certainly be saying more about this soon. We've got the all-important 2022 elections looming. I know people locally have been talking to me about these since before the last election. It was always going to be about 2022. Who takes over after Kenyatta? So this is going to be the story we'll be focusing on more and more. And again, we've got a special session this week just to look at that scenario. I am going to be paying a lot of attention to it myself. I recommend you do too. So big picture, Africa's recovering, not quite as strong as the rest of the world in 2021, but that's because it wasn't hit as badly. We've got the long-term stories that aren't changing, but I think the biggest shift we've seen in the last month or two is this special drawing rights story. So this is reducing default risk. You've also got commodity exporters doing pretty well right now with oil and copper and so on where they are. So it's a decent story. We're going to hear an awful lot more about that and which companies are the ones to be looking at to benefit from it most. Thank you so much for joining this video call, and I will speak to you in person at some point, I hope. Take care and see you soon. Bye.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Ladies and gentlemen, welcome back to Renaissance Capital in Africa. Sadly, again, not physically this time. We are again doing a Zoom conference, although we've obviously got our offices in Nigeria, Kenya, and they're working hard on your behalf at all times, along with South Africa and Egypt. I'm delighted to launch the conference with, I think, the best speaker on the issue of the day, and I think that's the special drawing rights increase that we saw in August. It's finally arrived. Reserves have gone up for countries. This is a big deal. We've been fully supportive of this idea. And when I was trying to work out who could talk to us about that, I couldn't think of anyone better than Abebe Selassie, who is the director of the African department at the IMF. He's had a 23-year history, I think, at the IMF, and he's been all over the continent. I think he had time in places ranging from Uganda to South Africa, as well as a host of the East European and other frontier markets that we've also we cover ourselves at Renaissance Capital. So first, Abebe, thank you so much for joining us. I really appreciate you giving us this time.
Thank you, Charlie, for the invitation. Thank you, and for the kind words also.
Well, it's I think when we first bumped into each other at the BBC office like 5 years ago when you'd just been appointed, and that was pretty cool. Coincidence for me too. But I wanted to start off by can you explain special drawing rights to me? I've obviously sent out emails to people, but there's nothing like hearing it from the man who's made such a difference for this in Africa anyway. And I'd love to just hear, what are special drawing rights? What can they be used for? I'll have some more subsidiary questions after you've given us a little overview of what's just happened.
Thanks, Charlie. So it's not so much me, but really the IMF, but really the international community that is utilizing this very important toolkit in the IMF's arsenal, which has been used from time to time. Basically, special drawing rights are, if you will, a form of the international community together coming and using the balance sheet of the collective, the whole membership of the IMF, 190 countries, to say that we will inject more liquidity globally, and this liquidity can be used by those countries that need it. It's a way of, if you will, kind of using the balance sheet of stronger countries to support other weaker countries, those that have pressing balance of payments need. And the way it works is that we credit almost every country the equivalent of its subscription, or quota as we call it in the IMF, with resources. So if you're I don't know, country X, you have $1 billion. If you're the US, you have 100 billion. You get that much in special drawing rights. The US, already has hard currency, doesn't need to use reserves as much, much more inward-looking economy. But country X probably has a need to supplement its reserves, or So what will happen basically is that country X will be able to exchange its reserves, its currency, for US dollars. So it gains a hard currency, which it can then use to import goods and services, to expand, to create fiscal space, basically. So that's the mechanics of it. Why it's important right now, of course, Charlie, is that we've seen over the last year and a half, the biggest shock perhaps to all economies, right? And those countries that have that are least resilient have been impacted even more, exactly because they have not had the opportunity to expand central bank balance sheets, go out and borrow as much as say the US, Euro area countries. Many other advanced countries have been able to. So an injection of SDRs at a time like this really is very, very helpful, particularly for those countries with weaker balance sheets. So it comes at a really very important time as the pandemic continues to persist across the world. Thankfully, the direct effect of the pandemic in our region in Africa has been not as much, except countries like South Africa, not as acute as elsewhere. But the economic effect has been as devastating, if not more so, exactly for the point I made earlier, that countries have not had the ability to cushion the effects of the pandemic on lives, livelihoods, firms. So it comes at a very, very important time. The effect basically is that about $33 billion Africa-wide is being made available. It's very, the amounts vary. I mean, depending on the size of the economy, and there are also historic reasons why kind of it lags and not just directly correlated with GDP size. But it's a very important boost, very important injection in the arms, as Kristalina, a shot in the arms, as Kristalina says, for economies. It creates fiscal space almost immediately. So we are very hopeful that it will provide quite a bit of support for countries.
So we've got, I mean, we're just looking at the numbers. I think South Africa is the biggest nominal beneficiary with something like $4 billion. Nigeria's got nearly $3.5 billion from this increase. They can use that tomorrow. They could go not necessarily to the Fed, they could go to the European Central Bank or even Bank of China. They could go exchange this for FX. They can spend that FX on whatever urgent needs that they may feel are most appropriate. And there's no restrictions here.
It's an unconditional injection of liquidity. Okay, but of course, so yes, they can do all of those things. A couple of not so much caveats, but a couple of points. In the past, what has tended to happen is that SDRs, because there is right now interest rates are very low, but there's a small payment that is due, basically the weighted average interest rate of the currencies in the SDR basket, which right now is close to zero. But over time, that if you use your SDRs, and over time, if interest rates go up, there could be a little bit of a cost associated to the use of the SDR. So what countries have tended to do is that they put the SDRs at the bottom of the reserve pile, if you will, and they use reserves, which don't come, free reserves, other reserves, to go ahead and make, purchases of goods and services. So 2009, when there was a $250 billion equivalent allocation, what we saw basically was SDRs being at the bottom of the pile, allowing other free reserves to be used easily. So, so this is a small caveat. Second, and more about policy making approaches, and I think the optimal policy making approach. When you have a windfall resource like this, okay, we of course, you want to make sure that you use it to address the pressing needs of the moment. But as always, you want to embed what you're doing in a medium-term framework, right? So I think, countries, I think, unlike in the past when perhaps there was a lot more short-termism in the conduct of macro policies in the region, I think countries are conscious, and I think a lot of the conversations that we are having about how you use the resource in the best way possible. Is it by, part of it could go towards immediately addressing, for example, need to finance vaccinations, perhaps, or support for vulnerable people at the moment. But whatever you're doing, you want to embed it in a medium-term framework, and then help ease that medium. This will help you ease that medium framework, but you want it to be consistent with what you're doing over the medium term. Very, very importantly, we are advising, and we very much hope countries also, do so in that direction. You do not want to use this SDR to forestall, to delay required or needed reforms. Okay, so if you use it to support an unsustainable exchange rate, or do fiscal policy that's not going to be beneficial over the medium to long term, that's not optimal use. So there are those considerations that I think we've been we've been having a bit of a conversation around, but really it's unconditional.
You're still giving advice, even if it's not conditional.
It's not. Sorry, just to be very clear. There are, with some countries, we clearly have
an arrangement
programs, but in others, we have Article 4 policy dialogue.
Yeah.
And this is not just, and other times kind of countries, we work very closely. We aspire to be trusted advisors to the governments we serve. And, we have conversations, and these are the kind of issues that we discuss. That's how.
I might be asking too specific a question here, but I read from a Swedish central bank paper about SDRs some like 10, 15 years ago that Zimbabwe had actually used up all of its SDRs over at some point or another previous allocations. And I was wondering two or three things as a result of that. Does the IMF keep a track of what the actual SDRs still held by countries are versus, that you've had the allocation? Do you keep track of who's actually got them still? Because maybe Zimbabwe sold its last set of allocation to the states and then used that money to manage its fiscal issues then. Second question is, could Zimbabwe theoretically, or any country, go back to the Fed, having sold its SDRs to the US to get dollars? Could it then go back and say, I want to go back, I want to get those SDRs back, please. Here are the dollars. And we'd like to have them back on our books. And then thirdly, I saw something, and again, it's about Zimbabwe, but it needn't be. It could be about any number of countries. They owe a debt, I think, still to the IMF or the World Bank. Could they use the SDRs to kind of pave the way towards improved relations with IFIs? I don't know exactly what Sudan's situation is, but maybe there could be more than one country that. So there's a few questions in there. I just want to, and if it's too specific,
so, in principle, the transactions between countries it is feasible to know what the SDR allocation of each country is and what the SDR holdings remain. And I think that information is public.
Okay.
It's been a while since I've
I can look on the website.
Second, you know, are these transactions reversible? Yes. Between countries. I mean, it's you know, in principle, it is reversible. And then third question about what reserves can be used for. I mean, first, to settle, yes, the resources can be used to settle outstanding obligations with, you know, to the IMF, etc. But, you know, we of course want countries to use these resources as much as possible to address the pressing needs that they have, right? And you know, like countries you mentioned, Sudan, etc. I mean, there is now kind of, you know, an arrears clearance, a whole strategy that's been agreed to address the arrears that were outstanding towards the IMF. Somalia also, if you remember, last year. So the hope is that, you know, these resources are going to be providing and supporting increased fiscal space rather than just addressing outstanding obligations to us.
Got you. I thank you very much for getting the basics sorted. At least I hope I've asked every question that people will have wanted me to ask. The second question related to it is the even bigger one, which started, I think, with President Macron a few months ago, saying, why does France need to get, you know, roughly $30 billion? We'll hand that over as well. You know, we will reallocate France's SDR allocation to countries in more need than France. And it's not just France saying that now. It feels like that's quite a broad-ranging agreement on this issue. You've got the IMF chief who was saying, I think she wanted proposals kind of in place by July. And I've been reading up about the Resilience and Growth Trust, as Resilience and Stability Trust, sorry, which is perhaps a way, a mechanism that's being created to do this. Why couldn't the IMF just expand the Poverty Reduction and Growth Trust, which was an existing program? I'm just trying to understand, basically I'm trying to understand the mechanics of this, because we could be talking hundreds of billions of dollars being reallocated. Are we? When? In what way would this money get used? Is it going to be more conditional? I think it is, but please, I mean, I know very little and I'd love to know a bit more.
So, you know, very deep question. So let me start by saying, yes, I mean, one of the really good things that have been happening over the last several months is recognition that there is going to be a need for low-income countries, vulnerable countries around the economy to have access to adequate financing to support the reforms they need to do to, you know, enjoy a strong recovery, to reverse a lot of the deterioration in social indicators, you know, that have happened over the last year and a half. So I think international community, there is a recognition of this. And so the question has been about, you know, how best to provide this resource. And, you know, SDR allocation offers an opportunity to do this. What is exciting also is the idea to go beyond the PRGT. In the past, if you will, one of the ways in which previous SDR allocations have been used to channel resources from countries that have comfortable reserve positions to those that don't has been the Poverty Reduction and Growth Trust that we have at the IMF, which basically works exactly the way you know, exactly helps use, there's a proof of concept about how this could be done. But there is a desire also to explore other ways in which even longer term financing could be done, perhaps financing that could go towards a lot of the transformational
infrastructure
things that countries need, you know, climate change, for example, type challenges, perhaps digitalization, you know, big medium-term agenda, right? To to support resilience to shocks, to support the transformation that really needs to be done in the coming years if we are to not be susceptible to more of these shocks. So and we've got the mandate by the G20, and with leaders like President Macron pushing very aggressively for the fund to be creative and thinking and coming up with ideas. We've also, so we've been working quite a bit on coming up with proposals that could entice countries that now are not using these SDRs to allow us to use them to support more vulnerable countries.
Yes.
Now, the proposals are very tricky because in principle, it seems easy, but as always, the devil is in the detail, and that's exactly what we're working at right now, to find ways in which every country has a different way of treating SDRs. In some countries, it's reserves. In some countries, it goes to the fiscal agent is the Ministry of Finance rather than the central bank. So coming up with a mechanism that's going to allow as many countries as possible to provide the resources consistent with domestic legislation, and then we need to find a way of on lending that. It's a bit tricky, but we're actively working on proposals.
It feels like, I don't think it should matter, but are the World Bank saying, get off our turf, this is our space, this kind of longer term financing, structural change, climate change? It feels like everyone's working together on this, are they?
So, okay, so SDRs can be held by what are called proscribed institutions. And among the proscribed institutions that can hold SDRs are things like multilateral development banks, World Bank, African Development Bank, etc. So it's not, again, that is also something that is being looked at. Is there a way in which some SDRs could be allocated there? But to be very clear, Charlie, the financing needs that prospectively face low-income countries, developing countries more broadly in the coming years, really are so large. Okay, it's not stuff that can. It's not the orders of magnitude are not ones that are going to be met just by the official sector. Okay, so the World Bank by itself cannot do it. The IMF, even plus the World Bank plus the IMF plus African Development Bank, would only go a small way towards doing it. Okay. So I think this is a time when we all need to work together. So the World Bank, I think, would strongly welcome whatever additional financing IMF can put to support a lot of the reforms that they also are working on. So it's not at all substitution that we're looking at here. Not at all. Okay. And the fact that the SDRs are perhaps more easily usable than outright grants that IDA relies on to countries also, makes this rechanneling an attractive proposition for the international community. But one last thing, we've been talking a lot about financing, okay? And I always worry, this is something really important to stress. The only way that, the primary way that the region is going to enjoy strong growth is through economic reforms, okay, is by identifying and alleviating the constraints on growth. And then financing is something that can help facilitate that, okay? So it's not just about financing, but, there's a very, very important and deep reform agenda also. And in fact, that's the primary driver of growth prospects. So I know you want the financing discussion, but the other stuff is much more important.
Yeah, no, I'm totally with you, and I think most of the investors I'd speak to would be much more in favour of this money being used sensibly and being used to support longer structural infrastructure needs to boost growth and to boost the potential for faster growth in the longer run and sustainable growth, not quick wins or financing a pre-election budget. I mean, and I think that's the issue of moral hazard that I think concerns some people about this reallocation of SDRs. You know, how is the money going to be? Is it going to be potentially wasted? How can it be monitored? And I think if what you're saying is, you know, that we could see World Bank getting involved, African Development Bank getting involved, that could be quite a smart way of delivery of infrastructure spend over time in a sustainable way. That meets those moral hazard concerns. Would be the way I'd see it. So to take this, well, do we have any sense of timing? I mean, I can see it's tricky. It feels like you've got a lot of institutions involved.
So I think, you know, again, there are various strands of work. You know, so PRGT, you know, financing is one of those. I think that's at hand. At least there's agreement on kind of the medium-term envelope that will be needed for the PRGT. It will require some fundraising, but that's like you know, a concept that already has worked in the past, and so that I think should happen, you know, in a shorter time frame. The Resilience and Sustainability Trust is an entirely new trust, so much will depend on how much support it is going to engender. So that is another bucket of work. And then there's also kind of, you know, the potential use of the SDR outside the IMF, you know, you know, by other prescribed institutions. That's yet another strand of work. And all of these require quite a lot of detailed work and negotiations, etc. But this is all happening as we speak.
Just to be clearer, sorry, of my own head, the PRGT feels like it was aimed particularly at the lowest income countries, and it feels like, from what I'm reading, the Resilience and Stability Trust might be including low and middle income countries. Am I missing something? Am I?
You know, the PRGT is indeed aimed at low income countries, but there is there's a horizon. The lending horizon for that is 10 years, basically, effectively. Okay. You know, with the RST, the hope is that we somewhat longer, tenures could be explored. But a lot of detail is still to be worked out.
Okay, and so if I'm hoping for this to be all sorted at the October IMF meetings, that's too early, is it?
You know, I really would, you know, it's difficult to say, really difficult to say. But you know, these things do take quite a bit of time to just conceptualize and then get the commitment.
I'm sorry to put you on the spot. Sorry. Look, moving on. We've got this situation of high commodity prices, places like Nigeria looking better, Zambia already doing well before the surprise election result. So a number of countries are getting a benefit from this. It feels to me that Senegal is likely to get its that stalled energy project back on track with oil prices up here. So this is all looking pretty good for quite a lot of countries. And now we've got the SDR increase suddenly making everyone look like a little bit of a better credit than they did a month ago. And the prospect of a bit more coming about through this reallocation of funds at some point. So the concerns I had early this year that when Chad, then Ethiopia and Zambia all are looking for G20 debt forgiveness, not just the debt moratorium on an interest where it got rescheduled, 5 years in the future, but actually a debt forgiveness. And the question was, who's next? It feels like, am I rash to say there may be no one next in the next year or two?
You know, 2 years ago, who expected this shock? Right? I mean, or 5 years ago, who expected the commodity price slump, right? So, you know, never say never. I mean, or rather, you know, you really always have to be a bit circumspect, right? So just on that issue, you know, I always have to say worry about kind of the association of, you know, the debt picture, as you know, is extremely heterogeneous, okay, in the region. Second, we have gone through a period of incredible shock. Okay, the likes of which we haven't seen over the last 100 years. I think it's absolutely no surprise that you have countries getting into trouble. In fact, the question is like, how come even more countries have not gotten into trouble, right? In terms of being able to service their debt as comfortably as what had been expected, in the pre-crisis scenarios on which activity was being based. Projections were being based, lending decisions, investment decisions were being based. So going forward, a lot will also depend on how we move away from this period of continued heightened uncertainty that we remain in. Okay, so some things are looking up. It's surprising how much financing conditions have remained easy for much broader swathes of countries than we would have expected 6-9 months ago, if you remember. Like everybody thought kind of that was it, right? Commodity prices have picked up. It will help countries that are commodity exporters. But again, this approach, monocausal sense that Africa is all about commodities is not right. So as much as, when oil prices go up, Nigeria and, even Chad will benefit, you have the likes of Nigeria or Malawi who import oil. That's a negative terms of trade shock. So again, a lot will depend on kind of, country-specific factors, the growth trajectory, the reform endeavor, how much they're addressing the need to mobilize more revenues, how much exports are growing, as it does on the global picture, and, or financing that is available from capital markets, IMF, etc. So always when it comes to the debt sustainability picture, just as we do not look at blanketly at Latin America and think of it as a class of, as an entire class. Yes, I mean, some commonalities, but I think in our region also, much is going to depend really on the country-specific trajectories that they will be on. And it's the interplay between all of these complex factors that will determine the debt approach. Now, what the G20 initiatives were designed to do was, at the height of that period of uncertainty we were in last year, they were designed to allow, the BSSI was allowed to effectively allow breathing space to countries. Right, and it was really much needed breathing space by the official sector, at least. The private sector was, invited to participate if they so need, but didn't. But it gave countries a lot of breathing space, which could be used to support families, to support small, medium-scale enterprises. And then came the common framework, G20 common framework, where again. Something that has been lacking, right? You have had the Paris Club, but not quite the rest of the official sector having a way in which it could provide possibilities for debt restructuring. So I think it really was an important innovation. Okay, bringing in other G20 creditors to say that in those countries where there is a strong need for debt relief, for debt restructuring, then the official sector will do this. Okay? It's important to contextualize what those things were about. Okay, I don't doubt. Okay, that there will be countries that will continue to have debt difficulties and will need debt treatment. But again, much will depend on, as I said, the economic outlook, global economic environment, and it will be the interplay of those things. One last thing I wanted to say is, we should welcome things like the G20 Common Initiative, exactly because, in much the rest of the universe, we do not have frameworks, right? We do not have
it becomes transparent
systems, right? That would allow debt restructurings. And as debt restructuring, sovereigns requiring, space is not unique to Africa. No. I'm still worried about Sri Lanka right now, but again, the
the SDR increase helps short term. That was an answer that was really good at forcing me to read between the lines of what you were saying, and I'm going to have a think about what it implies. But it feels like you're saying a framework is there, and with other G20 countries, and we can guess which one is the most important of them. There is now a framework that feels like it's working better from your perspective.
A framework was needed. It is there. Yeah. We hope, so it is important to make sure that this framework remains in place, so that countries that face difficulty can use the framework to be able to move forward. It's in nobody's interest, as you know, least of all the countries, least of all the people in these 4 countries, to have unsustainable debt burdens. Being a drag on growth on yes. livelihoods forever and ever. It's not in the interest of creditors either, right?
Indeed. What I wanted to give a little bit of space here for you to elaborate on a proposal that you co-authored with some others on the IMF blog. And I am going to make sure there's a link to that for clients when they read around this TV interview. How to attract private finance to Africa's development. You're absolutely on board with, I think, what many of us are about how to get money in an affordable way that doesn't lead to damaging debt default and all of the other problems a few years down the line. Could you briefly explain what you were thinking in your co-authored piece?
Okay, so really a lot of the work goes to my co-authors, Luke Giro and Kathy Patillo, who have been, who've done really great work thinking about this challenge. As I mentioned earlier, the development financing needs of our countries, even before this crisis, were tremendous, right? There's a huge need to invest in infrastructure, in health, and education. A whole gamut of things by countries. And of course, there's a limit as to how much the public sector can do this, okay? Even with the best of wills and huge effort to raise revenues, there is still going to be need for significant private sector investment in development areas to help reach the sustainable development goals, okay? And I want to be very clear. I think we do expect the state to be the provider of the lion's share of public goods and services, right? But if we want to meet the Sustainable Development Goals by 2030, it is almost imperative that additional resources also go into electricity generation, bridge building, ports, etc. Okay, so it really, really is important, because one of the ways we're going to meet the SDGs is through high rates of growth. That needs to be facilitated by, commerce, by trade. So, hard investments in these areas are important. When we look at the picture in sub-Saharan Africa, the contribution of the private sector towards, big infrastructure projects, etc., is really very, very low. About 5% compared to, significantly more in Latin America, in Asia, and the like. And the reasons for this are really very, very varied. In some cases, it's risk appetite not being there, financial domestic markets not being deep enough to have longer tenures that you need, because the horizon for these investment projects really are very long. And of course, there are implementation difficulties also in the region. I mean, I was just in Berlin for the Compact with Africa meeting the other day, and I saw finally the new airport has been completed 10 years after it was originally due to be completed. So imagine if Germany, with all of their efficiency, with all of the human capital, have difficulty doing large infrastructure projects. Imagine, the kind of challenges that you face sometimes with some projects in the region. So there's also, the risk is non-trivial, right? So we've been thinking about this and how how can we entice the private sector to do more in the region? I think first and foremost, it's about nothing new. Make sure that you have projects that are viable, that are well articulated with high rates of return, that you can get private sector to come in, create a regulatory environment that will facilitate this kind of investment. Second, also to explore possibilities in which a small portion of the government balance sheet could perhaps be used to help entice these investments. Now, this is something you want to be very, very careful about, think through deeply. But our governments give a lot of tax incentives to private enterprises, right? Why not consider ways in which the government can perhaps address some of the costs in public sector projects? There's already quite a bit of that, but we want to provoke thinking, we want to provoke debate in this area. The last point, really that I want to make is that it's not completely beyond the pale what we're saying, and I want to cite the example of telecoms, right? I mean, again, nothing new. It's a well-known example. We've seen how much telecom access has increased in the world, in Africa, right? I mean, more so than almost anywhere in terms of telecom penetration. A lot of it, of course, has to do with technology. Okay, but technology by itself would have been out there, if the private sector had not also invested, right? It wouldn't have been absorbed as much. The public sector would have been slower to perhaps introduce telecom services in our region. So we want to basically, cite that, I think, as a model where there's always trade-off between access and price. But I think in terms of how effective the telecom revolution has been, how effective the private sector has been in providing such important services, introducing it, expanding it in the region, I think it can be done. It can be done, and so it's about thinking about what is the equivalent of airtime cards for energy to improve electricity access. Again, these are things that are taking place on the ground, and facilitating those will be important going forward to make sure that the region's financing needs are addressed.
Yes, and I remember as a kid having a meter that we had to put money in to get our supply of electricity by the hour. And if you didn't put the cash, if you didn't have the coins at home, you could go dark for the night. So I do think there's got to pay things work. But the technology thing could also be changing in a positive way on energy. Was one of my thoughts about this, that the old way of doing electricity generation was a massive grid, huge generation plant, very expensive. And to make money on, you had to be secure on your revenue stream for many, many, many years. And it feels like with solar, plunging cost of things like solar, possibly wind energy as well, that maybe a return could be made more quickly. And for private sector investors who are a little bit nervous about taking a 20-year view, that becomes if it's a 5-year potential payback on a solar project, that much smaller, but potentially becomes an easier way of getting that capital in as well.
So, the way I see it is that there's going to be a need for multiple sources of electricity generation, multiple approaches, right? Yeah. So the government, I mean, given how limited electricity access remains in the region, there will continue to be need for these very large-scale infrastructure and energy generation, hydro projects, etc. Hopefully, greener and greener projects, but there will still be a need to add a lot more energy generation capacity in the region. Okay, so but you can also find microgrids, the points that you made, about smaller solar grids for smaller towns, etc. That perhaps where there is scope for the private sector to supplement what the state is going to be doing. So I see, that's how I see. So and if 15-20% of our energy generation need can be done by the private sector. That would allow significant fiscal space for the government to do some of the harder things, for the private sector to do, which is like, investing in hospitals, in schools, in universities, which we need more and more of, given the
size of the population growth.
Size of the population growth. And then one last thing I want to make to your investors, lest they how much I'm an advocate of this. 5-6 years ago, my then boss and I wrote a piece called "The African Century," about this century. And that was motivated really by one stunning for me number, which is that by 2030, so in 9-10 years, 1 out of every 2 new entrants into the global labor market will be from sub-Saharan Africa. Not even the whole of Africa, but sub-Saharan Africa. Okay, this at the same time that global working age population is aging so rapidly. Okay, I cannot think of an area, a region globally where there is going to be so much demand for consumer goods, investment goods than Africa going forward. So one way or another, that will manifest itself, right? This demand, this pressure, and I cannot think of more important, more interesting business opportunity than that. Then again, of course, I'm talking my book a bit, but.
It's a beautiful way to end this session. So, Abebe Selassie, thank you so much for your time. I'm really grateful, and we hope to see you again. And
thanks,
all of the money coming in too. Thanks.
Bye.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Hello, everyone. Welcome to our 12th Annual Pan-Africa Investor Conference. My name is Yvonne Muhango, and I am Renaissance Capital's Africa Economist and Head of Africa Research. Thank you for joining us for the panel discussion that I'll be moderating today, titled Navigating an Economic Recovery Amid a Pandemic. I'm delighted to introduce my esteemed panelists, Mr. Tobias Rasmussen, the IMF's resident representative in Kenya, and Dr. Hassan Mahmoud, Director of the Monetary Policy Department at the Central Bank of Nigeria. Let me tell you a little bit more about my panelists. Mr. Tobias Rasmussen has been with the IMF since 2001, working on a wide range of countries. Prior to his current assignment as IMF rep to Kenya, he was mission chief for Guinea-Bissau and had before that worked on Ghana and Zambia. He has also worked on countries in the IMF's Asian, Middle Eastern, Western Hemisphere, and European departments. Tobias Rasmussen holds a PhD in economics from Aarhus University in Denmark. Tobias, I'm sure I mispronounced your alma mater. Apologies there. Dr. Mahmoud Hassan is the Director of the Monetary Policy Department at the Central Bank of Nigeria. He currently serves as the Secretary of Nigeria's Monetary Policy Committee. Prior to his current role, he was the Group Head, Macroprudential Analysis in the Financial Policy and Regulation Department of the Central Bank. Between 2010 and 2015, he was the Special Advisor to the Governor on Economic Policy and Research. Dr. Mahmoud has a PhD degree in economics from the University of Surrey, United Kingdom. Welcome, gentlemen, and thank you again for making yourselves available for this discussion. To start off our discussion, I'd like to invite each panelist to give us a brief overview of how their respective economies are doing or fared during this particular pandemic. I'd also just like, before we begin, to mention to those that have called in that if you have any questions, please put them through on our comment box on our YouTube channel or email our PR team. But anyway, let's get started, and I'll ask Tobias to start giving his overview of the Kenyan economy. Thank you.
Thank you, Yvonne, and thank you for giving me this opportunity here. So a quick overview of developments in Kenya. I think, as with the rest of the world, obviously the onset of the COVID-19 pandemic was a big shock for the Kenyan economy. We saw that economic activities took a significant hit with disruptions to trade, transport, movement restrictions, school closures, all that. But what I would emphasize now is that from what we're seeing, the shock appears to have been relatively short-lived, with activity recovering robustly. Year-on-year, real GDP growth contracted by 5.5% in the second quarter of last year. That was the quarter where the shock really was felt. But we then saw improvement to minus 1.1% in the third quarter. We're yet to see GDP results for Q4 or beyond, but a range of indicators points to a strong rebound in activity, and one that has gathered pace in this current year. COVID is not over, of course. Case numbers are still high, and it's only a small fraction of the Kenyan population that has been vaccinated. But from an economic perspective, it seems that firms and people have, to a large extent, been able to adjust and get on with business. On the domestic side, activity seems in many ways back to normal. Traffic in Nairobi, my favorite indicator, is certainly as intense as ever. We're seeing a recovery in various production indicators too. Output of cement and electricity point to a significant increase in output over the past year. PMI numbers have been consistently above 50 in expansion territory, except for a dip in April when we went through a third wave of COVID. On the external side, we've been seeing solid growth in both exports and imports. Horticulture exports, which are important here in Kenya, have been doing particularly well. Imports, which had fallen when the pandemic hit, have subsequently increased across all categories, reflecting general pickup in activity, robust demand. In the financial area, credit to the private sector has been expanding, slowly but expanding, and the ratio of non-performing loans has been broadly stable. Deposit growth has been strong, and mobile money usage has increased sharply. The fiscal area is one that came under a lot of pressure initially. This was driven by a sharp reduction in revenue that bottomed towards the middle of last year. That was reflecting the reduced economic activity as well as lower tax rates implemented to cushion the impact on the population. But the picture there in the fiscal area has been improving alongside the recovery in activity. And also the COVID tax cuts mostly ended at the start of this year, so revenue has been picking up quite strongly. The overall deficit for the fiscal year, which ended in June, came in slightly below the budgeted 8.7% of GDP. So all in all, I think we can say that the economy seems to be moving along. with growth returning and the private sector back to business. COVID is not over by any means, and that, of course, means a still high degree of uncertainty about the outlook and hence need for caution. A key challenge will be to stay the course on the planned fiscal consolidation. Government debt in Kenya was already high pre-COVID and then increased further as a result of the widening deficits last year. So reducing the deficit as planned will be critical to lowering debt vulnerabilities. The recent fiscal results are encouraging, but this will be a multi-year effort. Also, I would point to that there are still some pockets of weakness in the economy, tourism perhaps being the most obvious area. Airport arrivals have been picking up, but they are still below half of pre-COVID levels, and a full recovery in that area still seems far away. So to sum up, I think there are certainly some significant challenges remaining, but also a lot of encouraging progress. Let me end there. Thanks.
Thanks, Tobias. That does sound encouraging indeed. We'll dig into some of the challenges, including on the fiscal side, during our session. Dr. Mahmoud, I'd like to invite you to give an overview of Nigeria. Thank you.
Okay, thank you very much. And I'm happy to be here with you all. I think for Nigeria, the statistics are not too different from that of Kenya. The shock came even prior to the shock. There are a lot of fragilities already in the economy, given that before the crisis, we had this oil price war in Saudi Arabia and Russia, and we see oil prices coming down to $14 a barrel. That's February, March of 2020. And we're battling with that. There are also issues around fiscal space in terms of meeting the huge infrastructural deficits. There are also some issues around the banking system. And then COVID landed, and that panicked everything and then truncated all the numbers southwards. In the first quarter of 2020, we saw our GDP from 2.55 to 1.89. By the second quarter, we entered the negative GDP of minus 6.01. That picked up by the third quarter to minus 3.3, I think. And then by the fourth quarter, we are out of the recession. So we also recorded a recession in 2020. By the fourth quarter, we had a 0.11 out of that. And by the first quarter of 2021, this year, we came out a bit stronger again with a 0.51. And by the second quarter statistics that we got from the National Bureau of Statistics just a few weeks back, we're doing 5.01. So technically, we're out of that. The forecast for the year is still, even the IMF forecast is still going to be above between 2.5 to 3% for 2021. So we came out of that. All the parameters, all the macroeconomic indicators include issues around inflation. We are having a downward trend in inflation before the COVID, and up, even though it was still not a single digit, we were projecting the preferred threshold was to have a single digit 6 to 9%. That's what we feel is comfortable for sustainable growth. But even before then, we had a 12.46. COVID came, it shot over 18% in terms of our inflation number. I mean headline inflation now. Largely driven by both food and core inflation. Our core inflation measures issues around the energy prices, electricity, PMS, petroleum usage at the domestic economy at the retail end, and then we have some measures that were taken to liberalize the power sector. So we saw some jack up in price. Those translated to the inflation numbers we got. Then we had the major issues apart from the legacy structural issues in the economy in terms of supply rigidity. We had the crisis that later came around banditry, kidnapping, and stuff like that, and that stopped, the production of food. There was production going on at the early stages, but getting those produce to the market was also an issue. So that also fed into, so food inflation was a major player there. But in recent times, we see month on month, the inflation numbers also coming down. We're still around 17.38% as at the last August numbers, or July numbers, yeah. We expect that to go further to around 13 or so, and by next year we should be crossing the borderline of a single digit for the inflation numbers. Other domestic prices include the FX rate. You may be aware that we also had some adjustments in terms of the rates because the demand pressure were just not couldn't meet up with that. There were, issues around revenue inflow. The largest source of FX inflow to Nigeria is from oil export proceeds that goes to government, which is sold to the central bank, and we use that to do interventions at the FX market and all the supply issues. So around those supply side constraints were also huge demand pressures. So you see that disequilibrium widening for a period of time, and the only strategic move to do was to make some adjustment, because had this rate we call official rate, which was way above the rate that was prevailing in the market. That rate was not supposed to be a transactional rate. It was supposed to be a rate that was just to clear government transactions, including payments of memberships or estacos to government workers. But we see that margin widening substantially, and issues were around rates not converging in the market. So we had some adjustments to narrow that and also moderate the demand pressure. And then we see the rates now going around. We have what we call the NAFEX rate. We have the importers and investors and exporters window, and that is the wholesale market for FX, or the major market for foreign exchange transactions within the bank, both from the demand and supply side. And that rate, the NAFEX, the rate that prevailed in America called the NAFEX rate, and that rate is now moderating to around 410, 412 over this period. We have also another segment we call the BDC. It's been existing, but the funny thing about that was the central bank was the one funding that market, and we also see this arbitrage building from the official rate and the NAFEX rate getting into that. So we couldn't differentiate between the BDC market, which is the bureau de change market, and the parallel market. So there's this confusion. Everybody calls the BDC the parallel market because that's the rates that most informal activities are anchored on. So we see that also giving pressure to other fundamentals of the economy. There's a high pass-through from exchange rate depreciation to inflation. So we see that also impacting our inflation numbers coming from the monetary fundamentals that are affecting inflation, apart from the structural issues I mentioned. On the external side, we also recorded a huge deficit over $5 billion. That narrowed by the first quarter of 2021 to around $1 billion. So technically that sector is growing, but we've still not reached the threshold of getting out of that. Projections are that by the third quarter, we'll start seeing positive numbers. Because of the lockdown and the monetary stimulus that came in, both fiscal and monetary, we saw a pickup in importation. So importation bills also drive the balance of payment position there to that skewness to where you see export not growing, but you see huge import bills. Some of them are tied to importations of machineries and stuff like that, given the interventions, because we had a lot of interventions, both monetary and fiscal, to the agricultural sector, manufacturing sector, aviation, power sector. So we see a lot of activities going on. The COVID brought about some lockdown. Technically, we had two major lockdowns in the economy. One lasted close to 4 months, and that was the biggest hit on the economy, because economic activity just went down. Interventions are already in trillions of naira, now to be billions of dollars, and that is still ongoing. Monetary expansion, there was no major adjustment in monetary policy rate per se, but the quantitative easing were also kind of expansionary move on the side of the central bank. For the financial system, we also had, they were more resilient than other sectors of the economy, while we saw negative performance in most of the sectors, including the SMEs and the huge number of unemployment that came from that. The banking sector was a bit more resilient. There were a lot of controls within the banking sector, consolidation activities even before the crisis, and there was a limit to what activities bank could do, purely financial intermediation. They don't go into pension activities, they don't go into capital market activities. So there was that, guard into that activity. So they were a bit more resilient. However, they were also, because of exposure to the oil and gas and manufacturing, we saw NPL numbers picking up gradually. Some of the capital adequacy ratios were, showing some fragility. So we had some forbearances for banks that were exposed to COVID-related businesses. That forbearances are still going on. Stress tests were done to see how sustainable the industry is. And lastly, on the fiscal side, that was also just like Kenya case was. Big holes were there. We're having issues, even though the debt to GDP ratio is still below 30%. We see debt servicing to GDP or to revenue building up substantially. Substantial part of the public debt raising were domestic, in the sense that we're also concerned about, even though concessionary facilities are a lot more cheaper and more sustainable, but we're also concerned about issues around exchange rate and the FX liquidity market. So you see a huge part of that debt coming from the domestic economy. I think, let me not talk too much, our external reserve position was still kind of stable. We were below $30 billion before the crisis, doing 28, 29. That stabilized around $33 billion during the crisis period. The IMF facility came in, rapid response support came in, 3.5 billion. Last year, this year, we have the SDR, another 3.35 billion. So we have our reserve around 37 billion now. It's a bit less than 37 billion, largely owned by the central bank anyway. So those issues, those are funds that also are used to, moderate movement in the exchange rate. We're doing a managed floating rate, but we still have some instances of interventions to moderate that excessive demand pressure. I think generally that is a picture of what we have. Stability is coming in at the capital market. We also saw some bearishness that came from the global uncertainties. There's a large foreign holdings of capital market equities in Nigeria, and that actually was a major issue also for the central bank in terms of the exchange rate demand that came in, the capital reversals that came from there. So many other things around that area. The market are also resuming some moderations. All the headlines are being muted. Headwinds have been muted now, but uncertainties still remain. There are some tailwinds that are also picking up some of those numbers. But at least we could see some level of stability coming in, both at the macroeconomic level, output growth, and on the financial system stability side. Thank you.
Thank you very much for that. That was quite extensive, and I think I'll go straight into Q&A. And in the interest of time, I'm going to address some of the questions that our investors think are pertinent. So Hassan, I'll start with yourself, and it will be related to FX, which is not a surprise to you. My question to you is, what is your response to those that say Nigeria's multiple FX rates, limited FX flexibility, and FX shortages are problematic?
Well, that's a valid observation. I must confess to that. But there are some domestic idiosyncratic characteristics of the Nigerian economy that inform that. One, like I mentioned in the overview I just did, the supply side is highly restricted. is a mono economy in the sense that the largest inflows are coming from oil revenue. We see the volatility in that side. It's also important to note that the growth trajectories I just gave were largely driven by the non-oil sector. And oil sector contribution to the economy now is less than 8%. So we see that diversification already coming on board, services, trade, commerce, manufacturing, driving that, so that the inflows now of FX that will go through export are getting more sustainable and reliant. So that is the supply side. We also have a huge demand side problem, in the sense that every other thing in the economy is being imported, including things that are to do with luxuries and other things that are just not essential. So you see the domestic economy not growing, or backward integration not crystallized, even from the oil sector. So deliberate efforts were made to provide FX for some sectors that we regarded as critical, real sectors, including SMEs. So we created some windows to address that temporarily, particularly like the SMEs that we want to grow. That's the largest employer of labor here. Created a small window for that. And then we now created the I&E window, which I just mentioned earlier, and that's where the bulk of the activities come in. The BDC window, the Bureau de Change, was supposed to serve, activities of less than $5,000 for basic travel allowance, business travel allowance. It's not supposed to be for opening LCs or doing importations and stuff like that. So we have those buckets that were just administrative measures to manage excessive demand within the economy. However, as we speak today, there's the real convergence in terms of the rates in those markets, because even the official window that I mentioned earlier is anchored on NAFEX now. So government transactions are on NAFEX plus a margin, and then the major market for FX transactions is the I&E window. And rates at that market has been a lot stable. Even during the crisis, we were doing $200 million a day in that market, even though there was crash. We used to do billions of dollars there. So for now, I can say we just have that NAFEX window, and every other rate are anchored on that NAFEX rate. So convergence is coming. Yes, there were issues before now, but we've seen a lot of stability in that rate. We're not really bothered much about overvaluation on the valuation. We expect market fundamentals to determine that. What we are more interested in is the supply side and the integrity of the financial system, in terms of the confidence that investors will have in that market to be able to bring in their funds and take out their funds when they want to go out with it. So that supply side and transparency of the market was key.
Thank you for that. What if I was to argue in response to that point, that the supply side could be helped if the market felt that the Naira was rightly valued? By that I mean if it was trading at its fair value, as opposed to being overvalued as it is today. Is that something the central bank considers? Is it of interest for the central bank to see the Naira to move towards its fair value? Would we estimate to be around 458 Naira to the dollar?
Well, it depends on who is doing the econometrics, and it depends on the underlying assumptions and objective of that estimation. From our side, like I mentioned earlier, issues around overvaluation, undervaluation will be determined by the forces of demand and supply. But if you have issues of instrumental market failure, then that price discovery role of the market is lost within that crack in the transmission. So it will not be wise for you to sit down for the fundamentals to do that. So that's why you have that managed flow thing and some kind of interventions that come into it because of these characteristics of market failure. For overvaluation, yes, if we have moved from 390 something to where we are 400 and something now, then there must be issues of overvaluation earlier on. But at the level we are now, we expect that this is a reflection of the demand and supply within the market. If market fundamentals dictate differently, we expect the market to flow in that direction. However, what is important is the liquidity and transparency of that market.
Thank you very much for those responses. I'll move along to Kenya now, Tobias. Tobias, tomorrow is a big day for Kenya. They'll be publishing the rebased GDP numbers. The last GDP release was in January, and that was for the third quarter of the year. And the delay since then is because the authorities, I'd imagine, have been preparing these numbers. The last time we saw Kenya rebase, when they announced was in 2014. They rebased from base year of 2001 to 2009 at the time, and apparently the new base will be 2016. But the last time they did rebase, we saw the GDP being revised up by 25%. So it was quite significant at the time, to $55 billion. Today, the size of the economy, at least at the end of 2020, is $100 billion. And my question to you is, what are your expectations of the rebased GDP numbers? Be it size or be it composition, growth rate? Do you have any expectations that you can share with us?
Well, let's see tomorrow when the numbers come out. I mean, I would really just point to that the rebasing exercise that Kenya has been undertaking is one that's been underway for some time. It's a significant piece of work. It's something they've been working on for several years, in fact. These exercises are recommended practice every 5-10 years to update the basis for the national accounts. So I see it really as part of that ongoing regular strengthening of economic statistics in Kenya. Overall, in getting to your question on what to expect, I think it's fair to say that the statistical systems in Kenya have advanced over the years. And as such, this is likely to be more of a incremental improvement, not likely to result in similar large changes as we've seen on some previous occasions when the exercise also included a significant expansion in the coverage of what the national accounts aim to measure. In particular, previous exercises led to broader coverage of the informal sector. So I think we've come to a more stable point where I would not expect similarly large changes as previously. In terms of individual sectors and developments in GDP growth, let's see tomorrow. Maybe I would just point to that we had estimated that real GDP growth in 2020 was close to zero. So soon we'll find out if that was right.
Thank you very much. We'll find out tomorrow indeed. I'll move along back to Nigeria. Hassan, I've got another question, and this is on inflation. Nigeria's inflation has been stubbornly high in the double digits for 66 months now, something you mentioned when you're providing your overview. We've seen inflation moderate over the past couple of months. And my question to you is, do you think it has peaked? I also wanted your view on why you think inflation has been sticky in the teens region. And when does the central bank think we'll see single-digit inflation again in Nigeria? Hassan, you're still on mute.
Sorry. Thank you. In the composition of our CPI, food, a component of it is taking close to 50, rather above 50%. So you see food inflation playing a big part of that. There's imported inflation too, but that is getting smaller and smaller by the day. But the core inflation side, which include PMS prices of petroleum product at home, electricity, and other sectors of the economy are also contributing to a big part of that. The food side of it has been sticky supply side rigidity has been on due to the structural issues that I mentioned. That was compounded by the crisis, the rural headsmen and other banditry crisis that has been going on for a few years now in the country. Prior to that, we had the Al-Qaeda and all the stuff that are also affecting particularly the northeast region of the country, which is the highest agricultural producing areas of the economy. So you see that supply side shrinking substantially. The issues around demand side, disposable income as unemployment and all the stuff were building up, and poverty was also increasing. So you see both cost push from supply rigidity and demand push from other incentives that were coming into the economy. So largely, we still claim that there's a debate around whether our inflation number is a monetary phenomenon or structural phenomenon. The central bank still holds that this is a structural phenomenon, but I won't deny there are other analysts that have said that monetary activities are also foiling that. We don't disagree with that 100%, but the real thing is still around the structural issues that you have around the supply, even with other commodities in the manufacturing sectors and stuff. Capacity utilization is still very low because investments in capital and fixed capital and other machineries is still below expectation. Financing deficit are there, and we're doing measures to also attract both private and foreign capital inflows to address that. So we see that applying to the numbers you see in terms of our month-to-month inflation number, the headline inflation. And that's why also, since the primary mandate of the central bank is price stability, we've moved to unconventional monetary policy tools to address those supply side problems, including interventions in agriculture. We have something we call Anchor Borrowers Program that gives funds to rural agricultural farmers to produce. These are not just cash, including improving the seedlings or the yields of the farm, that is productivity, and it's through the entire value chain of the agricultural sector. So we see interventions going on there substantially to offset that supply side problem that we have. And if that crystallizes, as we are seeing the numbers now, largely the GDP numbers I mentioned for 5.01 at Q2 2021 is largely driven by the agricultural, manufacturing, then you have the services sector. So that supply side issues, I can say substantially, is accounting for this sticky downward trend of our inflation numbers. But for now, I think we've reached the peak and the downward trend, because before this tickling downwards that we had inflation month to month growing for close to 19 months. Every other month you have some decimal increase in inflation, but 3 consecutive months now, month on month, and we have seen decline in inflation numbers. We believe that the interventions are already yielding fruit, and there's a lag period for that to crystallize substantially into the economy. But in the next 1 or 2 years, we should expect that to impact significantly in terms of agricultural, private sector investments in the agricultural sector, which is the main supplier of the food. And then you see the services and other sectors, manufacturing, industrial output growth, also impacting the supply base. You see the numbers or inflation numbers going down. Yvonne?
Thank you very much, Hassan. It was very interesting to hear you explain the central bank's view on the drivers of inflation being structural and how that links to some of the measures that have been taken on the farming side, something that some might consider outside of the central bank, but it was good to hear your reasoning, the central bank's reasoning on why Nigeria has opted to go in that direction. I guess time will tell us whether it is becoming effective. Thank you for that. My next question I'll address to Tobias, and it's related to 2 sectors, manufacturing as well as exports. So this is often a question we get from investors and observing what's happening in the manufacturing sector. So firstly, manufacturing, which is, is the second biggest economic sector in Kenya after agriculture, has tended to exhibit weak growth over the years. It's certainly been weaker than GDP growth. And I'm interested to hear what you attribute that to. There's a second part to that question. And I'll tell you why I think they're related. Secondly, we've also noted export to GDP ratio falling for the past several years, from around 14% a decade ago in 2011 to 6% in 2020. I know 2020 was a particularly poor year, but it wasn't much higher in 2019. I'm keen to hear what you think the reasons are behind this, and if you think the shilling could be a contributory factor. Thanks.
Thank you. Yeah, I think the questions in relation to Kenya's manufacturing performance and following that also the export performance it's not a straightforward one to answer, and particularly because when you look at many of the metrics that one normally looks at in terms of what we think important for private sector development, then Kenya has actually been doing quite well. For example, its ranking in the World Bank's Doing Business indicators improved sharply from 129 in 2014 to 56 in the most recent survey. And perhaps not quite as strongly, but on many of the other indicators of business environment, Kenya does relatively well. There are perhaps some questions in particular areas. Electricity, for example, prices in Kenya are higher than in neighboring countries, but they haven't been increasing. So it's not obvious that really that explains a weaker manufacturing performance. I think part of the story has to do with the sector not having been sufficiently innovative in terms of adapting to a changing environment, a changing competitive environment globally, with more competitive pressure from China and other countries outside the region. Kenya used to be somewhat of a manufacturing hub for the East African region, and I think in recent years has struggled to maintain that presence in face of stronger external competitiveness. You then drew the link to export performance, and I think indeed there is a link there. Goods exports have not been performing well, and again I think it's at least to some extent due to the product mix, with exports increasingly focused on a few agricultural products, tea, coffee, horticulture, where Kenya is competitive, but I think the challenge is that these are not very rapidly growing markets. So Kenya has been doing well there, but it's not really a market that has been growing much. And in some of the potentially faster growing areas in manufacturing and so on, the country hasn't really been keeping up, or I should say the sector hasn't really been keeping up. And I think important to also recognize that in as much as we're talking about sectoral performance, the numbers you quoted were all for goods exports. I think Kenya has been doing better in services, financial services in particular. There has been a broader shift in the economy towards the service sector. So that's an area where we see much more dynamism and expansion. But manufacturing indeed has been weak. In terms of exchange rate, I mean, I would simply note that our most recent external balance assessment or external sector assessment indicated that Kenya's external position was in line with fundamentals. So we don't see misalignments there. Kenya has a flexible exchange rate regime, and we have been seeing movement in the exchange rate, which is a good thing. And it has a very open capital account. So I don't think the problems are necessarily there. To me, it suggests more a question on product mix and perhaps lacking innovation in that particular sector of manufacturing.
Thank you very much. That was very insightful. I'll move back to Nigeria, Hassan. First, just to finish off the inflation discussion, I wanted to hear your views on the interest rate trajectory from here on out. I know in 2020, the Monetary Policy Committee cut the policy rate by 2 percentage points, 11.5%, and that was their way of providing an accommodative environment to shore up growth. We are seeing growth pick up. Inflation, as you mentioned, has started to moderate. What indicators do you need going forward to give you comfort to return to more orthodox monetary policy? And in case we differ in terms of opinion on what I mean by that, basically, do we expect to see more tightening because at this levels, inflation is higher than the policy rate?
Thank you. There's always this dilemma for monetary policy committee members in terms of whether to tame the inflation or to drive growth. And sometimes you see some cross restriction between those objectives, and there's a need to balance where do you want to go. During the crisis, generally monetary policy tools have their potency level weakened substantially, particularly given the kind of economic structures that we operate in. But the adjustment by the central bank of the monetary policy rate by the 100 basis points that brought it to 11.5% was just at the beginning of the crisis of the COVID pandemic to enable banks now to extend credit to the rest of the economy. We also have what you call the LDR, which gives a volume of about 65% of the total funding position of the banks to be lent out to the rest of the economy, because we see that credit conundrum within the economy, and that was a regulatory requirement, a prudential requirement for banks to meet to extend credit to the economy. However, we could also, theoretically talk about the transmission mechanism of monetary policy to domestic prices, including the lending rate in the banks and the savings rate and other rates, including the FX rate. That transmission is also an issue that we consider in terms of how we use monetary policy tools, and that also informs the unorthodox monetary policy instruments that are being used to drive that. Generally, what is important for financial institutions is the risk profile of the economy, in the sense that they're able to recoup some of their assets that were created in terms of not getting the NPL numbers high. There's also a regulatory threshold for that. So you see that coming up in the behavior of banks too, in terms of which sectors they invest in. The sectors that are supposed to drive employment creation and drive growth faster, the real sectors, are the sectors that are less lucrative for the banks. Agriculture and other sectors that you see will be impacting more on the economy than exchange rate, foreign exchange issues around that, and other services that are not connected to the labor intensive potentials of the economy. So for Directory of Monetary Policy, or the direction of monetary policy, when we see a sustainable growth in the GDP numbers, and that sustainable growth in GDP number will also include that the GDP growth is inclusive, productivity is also increasing, capital utilization is also increasing, then you see that translating to employment creation, well-being of the rest of the economy. Then you start seeing, central bank now, adjusting way to tighten. But for now, if you tighten, you want to create credit to the rest of the economy from the private sector. The tighten rate goes up, you're also defeating your objective at the other end. So that balancing act is required at all time to be able to face monetary policy, price stability, their primary mandate, and also consolidating on this growth recovery that we are seeing more or less post the pandemic now going forward. So I think that is still an issue, and then simultaneously we're still dealing with that dilemma. The monetary policy framework is monetary targeting, so it's the quantity of money in the economy that we use to moderate prices. But when you see those frictions I told you about within the market system, then you require some administrative tools to address some of these things. Indeed, those are supposed to be transitory and temporary tools, so that the bank concentrates on its core mandate in terms of using monetary policy tools to drive the actualization of its own policy objectives.
Thank you. So we've got about 11 minutes left, so I'm going to put in a couple of more questions in before we conclude. And Tobias, I think we should address the fiscal side. I think which is probably one of the biggest challenges in the Kenyan economy. We noted in April that the IMF board approved a $2.34 billion ECF and EFF arrangement for Kenya, and it's intended to help Kenya reduce its debt vulnerabilities, which you mentioned earlier, through a multi-year fiscal consolidation plan that is centered around raising tax revenues and tightly controlling spending. We noted at the time, those of us who follow the Kenyan media, that some Kenyans were unhappy with the IMF providing a loan to a government that they felt was already over-indebted. Public debt is sitting at over 70% of GDP. And they were concerned about that funding also being mismanaged, and previous projects were cited. My question to you is, what is the IMF's response to those concerns?
Yeah, so those reactions that you mentioned, this was something we saw especially on social media, and especially in the days surrounding the approval of the program by the IMF board in early April. It was getting a lot of play, mainly in the few days between the board meeting and before the staff report was published. So before people really had a chance to see what the program was about. So I would note that the concerns that were being expressed in those days about government debt and about governance are in fact central to the IMF supported program. Reducing debt vulnerabilities through a multi-year fiscal consolidation is really the key objective of the program. The program also includes important measures to promote greater transparency in public accounts, and to strengthen the anti-corruption framework generally. So, I mean, what I would say is that the concerns that people have are not at odds at all with the program, quite to the contrary. And I think that also became evident to people once they had a chance to read the program documents. So these expressions of concern seem to have faded away. But let me also just say a few words then on the fiscal performance so far. I had mentioned in my opening remarks that the outturn we saw for the most recent fiscal year was encouraging. The budget had provided for an increase in the deficit in response to the COVID shock, and in recognition of the impact on revenue and added spending requirements that came with the shock. But that the deficit target was then met in light of those circumstances, and the deficit target was for a quite modest widening of the deficit. That this target was met, was exceeded, I think was a important accomplishment, and particularly encouraging to see that revenue performed well in line with target, reflecting a sharp improvement during the second half of the fiscal year. This comes against a backdrop of revenue having underperformed in the previous several budgets. So a quite important change there. With the program, this is a 3-year program. We're now looking to see significant reductions of the deficit over the next couple of years. It's been an encouraging start, I would say, but obviously also there's a way to go yet. Thank you.
Thank you. I do agree. It is encouraging to see the revenue pick up because they've for several years failed to meet their revenue target. So that is encouraging. My next question is to you, Hassan, and this is from our banks analyst who would be impressed if I didn't put this forward. It's regarding, it's a banks related question. So it's regarding the special bills, the various parts to it, but basically his questions are around the volume. So basically what percentage of the CRRs were converted to special bills, what the interest rates would be, and what happens at maturity, as well as liquidity, if they're being traded by banks, and implications of the low rates on the bank's returns. If you can address any of those, that would be appreciated.
Yeah, thank you. I mentioned earlier about the monetary policy framework, and that our operational target is the monetary aggregate and the volume of money within the economy. We see over the years some level of liquidity within the banking system, which is not unrelated with some of the avenues of or the risks attached to extending credit to some sectors of the economy. And I also mentioned around the LDR loan to deposit ratio, which was increased to enable banks to lend to the rest of the economy. Because what we generally find is those idle funds, if they don't go into the real sector of the economy to drive growth, they go to attack the exchange rate in terms of demands or investments, or they go to investments in treasury bills, which is more or less like government financing of government, which crowds out the private sector. So the special bills was created to take some of this excess liquidity out of the system, because there's an extent to which we can go in terms of increasing the CRR, in the sense that we tighten the bag from both ends. You're asking LDR to increase, and then you're also tightening at the CRR end. So the special bills is in terms of the volume now, it's just a little less than 5 trillion naira, and then the rate at which that operates is supposed to 0.5%. It can be traded between banks at the interbank segment of the market, where the banks can use that to manage their liquidities within the system, within the interbank system. It is not supposed to come back to the central bank to be discounted for cash or whatever, because except if we have also a 5% window where you can take from your CRR to extend credit to some real sector or priority sectors of the economy. You have access to that. You can come at any time to take it. However, if you don't have anything to do with those funds outside there, then you just hold it here for us to be able to achieve our monetary policy objective. So around the special bills, that is just principally what it is supposed to serve. You also have the OMO, which you're very much aware of, and how along the line we come to have foreign investors in OMO, and that was also going to be impacting on our FX numbers. Originally, OMO is supposed to be a transaction between the banks and the central bank, but we also use depositors' funds to do that. So at the end of it, we come to see that that signal coming out, on which we needed to manage in terms of the supply side issues that I mentioned around FX, so that when there's a rush for those OMO foreign holdings of OMO to go out, it will impact on our system. So there was a systematic work on that in terms of how we manage that, not to bring too much distortion into the market. So for the special bills, I think that is just the purpose it is meant for. It's a very successful tool used by the bank, in the sense that we're able to have some sanity within the system, and that has also helped the money market rates. You see that the treasury bills and the OBB rates that went down to close to zero during the peak of the crisis are all picking up now, and that is also translating to the fixed income and the equities market. So you see the market reviving substantially, and those are also rates that we look at in terms of seeing the responsiveness of our of monetary policy rates to other money market rates. Yvonne.
Thank you very much. We've come to the end of our session, and I just want to invite each panelist, if you have a couple of words you want to say in closing, you're welcome to. Hassan, I know you've got a flight to catch, so you're time constrained, but if you wanted to mention the digital currency in this short window of time, this is your opportunity to do so. So I'll invite you to say something there.
Yes, the Central Bank of Nigeria is also in that space now, like many other central banks in the world. We have issues around cryptocurrencies and how that was penetrating into our banking system, and systemic risk coming up, and we had some measures to curtail that. The central bank is launching its own digital currency. It's going to go live by the October 1st this year. Principal objectives of that, apart from addressing monetary policy issues, apart from addressing payment system effectiveness in terms of cost of transactions and the speed of transaction and efficiency of transactions and cross-border issues, it's also a major tool that we use to penetrate our financial inclusion objectives, including the government using that as a channel to get transfers, fund transfers to the rest of the economy in a transparent manner, in a monitorable process at least cost. We also expect that also attract remittances, since cost of remittances to Nigeria is high. So we have a lot of buckets. It's supposed to be a kind of two-step retail approach that we're going to be adopting for the digital currency, which we're going to be calling e-Naira. and then you can do P2P, P2P, merchant to P. All the buckets that are all available in that space, but principally to make transfers and settlement extremely fast and soft and cost effective for the economy. Let me not delay my own flight.
Yes, indeed. Thank you very much. Tobias, do you have any closing comments?
Well, maybe just to point to, given that we were talking about digitalization and those issues there, the mobile money experience in Kenya, I think, has been quite instructive. So government took the initiative to try to really push mobile money usage, where Kenya was already a leader pre-COVID, but to advance that during the pandemic for health reasons, to avoid physical transactions, but also really to stimulate that area. And some of the results have been quite remarkable. Mobile money transactions have almost doubled compared to pre-COVID, with transaction volume of over 5 billion a month in recent months. So I think something encouraging to point to there.
Indeed, and maybe I take an opportunity to mention that we're having a Nigeria FinTech Day on Thursday. So the all FinTech talk on that particular day being hosted by our banks and FinTech analyst Soji Solanke. So if you have time, please join us. And just to conclude, I don't want Dr. Mahmood to miss his flight. I would like to thank you both for being so generous with your time. This has been highly engaging and insightful, and I hope to do this again, hopefully in person next year again. Thank you all. Goodbye.
Thank you.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Good afternoon, ladies and gentlemen, and welcome to our Nigeria and West Africa Oil and Gas Outlook panel. I'm Nick Stefano, RenCap's Africa Oil and Gas Analyst, and joining me today are Mrs. Egisan, Group General Manager for Corporate Planning and Strategy of Nigerian National Petroleum Corporation, Neil Shah, Cosmos Energy CFO, and Emeka Onwuka, Seplat's Energy CFO. Thank you all for your participation today. The past year and a half has been a turbulent period for the oil markets, and although oil prices have recovered materially in recent months, the energy transition is a theme that is here to stay. For many countries in Africa, in particular Nigeria, which has recently made some major changes to its hydrocarbon legislation, oil and gas is a material source of revenue. And today, we'll try to address some stakeholder questions about Nigeria's and West Africa's oil and gas outlook. Mrs. Egisan, I think we should start with you. I'd like to congratulate you and the Nigerian government for passing the petroleum industry bill into law. It looks like the amended version of the bill contains improved fiscal terms relative to the original draft that was sent to the chambers last year. And I was wondering if you could explain to us what was the feedback from the upstream sector. And do you think that now that the bill has become law, investment in Nigeria's oil sector will be invigorated?
Yeah. Thank you very much. Indeed, the PRA is a major win for the Nigerian economy, specifically for the oil and gas industry. The bill, like you all know, has been under review for over 2 decades now. And seeing us to the end of that journey was a major win for all stakeholders. At the time, like you said, the bill was presented to the National Assembly last year, and the ensuing public hearings that followed at the National Assembly. The National Assembly gave assurances that they will engage all stakeholders to address concerns because the major objective was to enact a bill that was competitive, that offered Nigeria a competitive edge in the oil and gas space. So engagements occurred, after the presentation of the bill, and I think the final outcome is what we consider a win-win for all stakeholders. So I think the National Assembly, working with their consultants, benchmark what was presented, and after very, very interactive consultations with the major industry players, we all agreed and came to the final draft that we have today passed as law. Now, what does that portend for Nigeria? We believe that this is a major win for the Nigerian oil and gas industry. Over the last couple of years, we have seen a dearth in investment in the industry, and that was really as a result of unclear fiscal terms, for major participants. And because of that lack of clarity, most IOCs preferred to divert their investment capital elsewhere. Today, we have a bill that I believe competes favorably with other clients, and therefore we believe that we will see an attraction of investment in the oil and gas space.
Thank you so much for your answering explanations. Now, Emeka, the next question is for you. As Seplat, is an oil and gas company in Nigeria. How does the PIB, in your and Seplat's view, affect Seplat and the broader Nigerian oil and gas sector? And do you see any specific opportunities for investor?
Well, thank you very much, Nick. I'll just start by echoing what Mr. Egisan talked about. The long-awaited bill has been passed, and the industry is quite excited because it provides a lot of clarity and certainty in terms of the direction of the industry, and definitely will enhance confidence in the industry. The global transition, global energy transition gathered space. Most of the IOCs and the players in the industry will continue to evaluate the competitiveness of the fiscal regime they see from one territory to the other. And the fiscal regime we are seeing in the PIA, it competes favorably, like Mr. Ian talked about. And we believe that this will enhance confidence and attract more investments into the sector, particularly for projects that previously have been deferred, projects that were still on the drawing table because of the uncertainties around the fiscal regime. We believe that those projects currently will be undertaken by the IOCs and also by indigenous companies as well, because the whole significant changes you see is transformative for the industry in terms of consideration. Now, two major areas as well we need to highlight, apart from the governance and the regulations that are changed for the better. The fund that they established for the midstream and the downstream gas business will play a very big role in improving infrastructure to help make the gas industry attractive in terms of more extraction of gas. And you also know the issues we have of the communities and the fact that the oil companies have to have a good relationship with their communities. The new requirement of a 3% fund in terms of spend for community engagement is also very welcome. We as CEPLAT pride ourselves the fact that we work very closely with the communities and have over the years a very good relation. This will enhance that relation in terms of the funding that is required for that sector. So I believe there are great opportunities ahead for oil and gas business in Nigeria.
That's very helpful. Thank you so much. So in a nutshell, one of the things you said is that the new improved fiscal terms will make a lot of these projects that have not, yet been sanctioned even more competitive, and you do see them, been developing, further, getting the go-ahead, the green light in the future. Mrs. Seyesan, back to you. So the bill will convert NNPC to a limited liability company, and JVs could become so-called incorporated JVs. Now, I presume a reason for this plan was to make financing easier for NNPC and those JVs. And Mr. Chiari yesterday, the managing director of NNPC, said on a Bloomberg interview that the company could do an IPO as early as 2024. Could you please go over the plan for NNPC and its future direction, please?
Thank you very much. So indeed, the transition program for NNPC has somewhat been captured in the PIA. 6 months after the enactment of the Act, NNPC will be a fully fledged CAMA entity. Thereafter, 18 months thereafter, the separation of the NNPC Limited and NNPC would have occurred, with assets transferred, assets that NNPC isn't willing to progress with, transferred or retained within NNPC Corporation. And that corporation will be wound down by the Minister of Finance and the Minister of the Petroleum Resources. It will interest you to note that in the last 2 years, NNPC has actually been working towards a commercially viable entity. We have as our mantra the TAPE agenda, which basically says that we will be more transparent, accountable, and we will strive for performance excellence. In the last 2 years, we have really worked towards attaining that. And a testament to that is the results of our 2020 audited accounts. So it's reassuring that the bill recognizes that we will be going into that state, and we've already jump-started that even before the enactment of the bill. So NNPC will metamorphose into a CAMA entity, like I said, and we will strengthen the commercial status that NNPC currently has attained and ensure that it is fully a profitable venture company, and its subsidiaries are also run as such. The bill also recognizes that the current joint venture organizations that we have, the current joint venture businesses that we have, are at liberty to transmute into incorporated joint ventures. It won't be a mandatory requirement, it will be a voluntary requirement. And I believe that for every entity, that will be the ultimate goal, because like you rightly said, in leading to this discourse, that it will be a basis to access financing. And we know that for oil and gas business, that is a key requirement. So I think it will be in our best interest, to transmute these companies, our unincorporated joint ventures, to incorporated joint ventures as soon as possible. So the timeline is ongoing, and in terms of the IPO, I believe the bill says that 3 years after the enactment, that the NNPC will be able to open its shares up to the public, and I think we will work towards that, as we progress.
Thank you for this. And as a follow-up, the rationale behind the listing of NNPC, is it to enhance the local Nigerian stock markets, or is it to give an opportunity to Nigerians to invest in this company themselves?
I think it's a mix of all.
Fair enough. It's a good answer. Neil, let's talk a bit about, since we're on this financing topic, I'd like to ask you if you have seen a change in the oil financing and reserve-based lending appetite since the pandemic's outbreak. In other words, are banks concerned about ESG or increasing credit risk, and with the MPs? And do you think that debt capital markets could actually be more prevalent than reserve-based lending facilities in the future?
Thanks, Nick, and good afternoon to everyone on the call. It's a good question, because I think there has been a lot of change in the market. But I think on the whole, core banks and investors continue to remain sort of committed to the space and committed to bank and bond transactions. As you know, we've been active this year, with our RBL extension, our senior notes offering, and with BP's recent capital raising for the FPSO sale and leaseback transaction in Mauritania, Senegal. So seeing quite a bit of transactional activity this year. There are changes in the credit markets. And they are happening as both banks and investors and companies evaluate how they modify their portfolios to take into account sort of ESG and the energy transition into their own strategies. And so I don't think it's as much around sort of the bank market versus the bond market or credit investors. I think both are becoming more vocal in requiring companies to support their ESG agendas that are aligned with their financial institutions and how they want to deploy capital. For Cosmos, we've been welcoming this approach and have had positive discussions with our banks for quite some time over the topic. We would like to be at the forefront of the issue. We have a portfolio and a strategy that's well aligned with the direction in which the banks and investors want to go, and that's why I think we've continued to see support. Our growing gas portfolio, largely and with the Tortue LNG project, is set to become sort of a major part of our production portfolio in 2023 beyond. And as you know, gas is seen as a major partner to renewables through the energy transition, and so having a large exposure to growing gas and LNG is a positive. We're also investing in low cost, low carbon oil. We have infrastructure-led opportunities within Equatorial Guinea, the Gulf of Mexico, which can provide sort of shorter cycle, low cost oil with significantly less emissions than new greenfield projects. So we can provide the world the oil it needs in the short term. And then lastly, we have a 2030 Scope 1 and Scope 2 net zero emissions target with a measure, mitigate, and reduce strategy for emissions. And we're investing in nature-based carbon capture solutions to offset any other emissions that we can't mitigate. And so, I think we're doing the right things across the portfolio to continue to get that support. And that's going to be critical to ensure financing access in the future. There is probably a bit less appetite from some of the smaller fringe banks who are still assessing how core the oil and gas market is to their portfolios. But I think for good companies with the right ESG agenda, financing will continue to be there in both the bank and the bond markets.
So thanks for this comprehensive answer. And it was also quite interesting to know that I think you had some ESG sort of like KPIs linked to your interest. That's fairly unique, I think, from any company in the oil and gas space I've seen. Do you maybe briefly touch on that? You want?
Yeah, no, we've had happy to, Nick. We had a long conversation with our banks around, we think it's important that we continuously improve along our emissions trajectory. So it's not just sort of putting a target, but that there needs to be hard goals set alongside those ambitions. And so, we did build that into our RBL facility. I believe it is the first sort of West African RBL to have sort of ESG KPIs built into it, but it provides us some economic incentive along with, to demonstrate continued improvement on that path to lower emissions. And for them, for the banking market in total, I think it helps demonstrate to their sort of credit committees that they are investing in a company or supporting a company who's doing the right things along with where they want to go. And so it's a win-win, I think, from that perspective. And again, I think this is an issue where we feel importantly that we're sort of doing the right things and we may be at the forefront of it, but I think it's very much the direction the industry needs to go in.
Thanks for this, Neil. I've got some more ESG questions coming up later, but for now, let's move back to Nigeria. Mrs. Seyesan, the government has declared this decade as the decade of gas. But if we look at some of the reported numbers, and in general, it looks like in the past few years, the domestic gas landscape has changed very little. So don't you explain me, what the government's targets are for domestic gas in Nigeria and how they're going to be implemented?
Thank you very much. I'm surprised from your paradigm, you see very little changes. From where I sit, I see substantial changes. 2005, we were barely doing 300 million scf of gas domestically. Today, we are doing close to 2 billion scf, and I think that's a substantial improvement. And what has supported that growth? It's basically the commitment of government over the years. In 2017, the Gas Master Plan policy was approved by the Federal Executive Council. And since then, the Minister of State, the NNPC, and active stakeholders in the gas space have been working, around the clock to ensure that we deepen and expand the gas footprint within the country. So, most of the issues that really held the gas sector down, I believe, have been addressed, and the decade of gas is to ensure that we really push that envelope, to the greatest heights that we can get to. By 2025, we hope to increase our current domestic gas utilization to about 4.5 BCF. And that is not just on the drawing board. The current infrastructure projects that we are doing is to support that aspiration. The AKK project which was launched at the height of the pandemic, is a testament that this government is putting its money where it needs to. You know, over the years, indeed, we had paid lip service to the gas whole revolution, but now government is committed to funding and implementing critical infrastructure projects. Apart from the projects themselves, gas appropriate pricing. You know, over the last year, industry stakeholders worked together to ensure that at least we all agree on gas pricing that will support, you know, investment in the space. And a few weeks ago, the minister also announced gas to power, a reduced gas to power pricing. So all these are things that the government is doing, and we know that our stakeholders like Seplat is increasing as well their gas footprint to ensure that we expand the domestic gas space. And it's not just in the domestic gas space, even for export. At the height of the pandemic as well, we concluded FID for Train 7 of the NLNG, you know, to increase the NLNG capacity. And I think these are very, very clear strides, you know, that this government and the active stakeholders are all working towards achieving. And this also ties on with aspirations to decarbonize as well, because even as we use gas as a transition fuel, we are also working towards seeing efficiencies, you know, in our utilization of gas as we go down that path.
Thank you so much for this. So if I should take then the government's target for domestic gas is 4.5 BCF per day in 2025 from 2 now.
From about what? Yes, almost 2.
Okay, thank you so much for this. Neil, let's go back to you and talk a bit about M&A. You guys have been active in several countries in Africa and also quite active inorganically in the past. And we're seeing a trend in recent years where smaller players are trying to take advantage of the exit of the larger companies from some assets. And the private equity market is also, you know, quite hot there as well. What are your thoughts about the African M&A space, and are the prices where you would expect them to be?
No, it's a good question, Nick. Yeah, I think, you know, Cosmos has been active in the M&A market and has quite a good track record where we've targeted assets that fit well into our existing portfolio, and where Cosmos has a unique opportunity to add value in places where we're very aligned with the governments, which know that Cosmos is looking to invest and grow, not just produce. The EG acquisition from Hess in 2017 is a good example of that, of a transaction that makes quite a lot of sense financially, with payback in less than a year, but also brought an asset base that has a significant amount of future upside potential in the right hands. We are seeing more opportunities like that in the market today, as majors and large independents reshuffle their portfolios, both in West Africa and in the Gulf of Mexico. There are lots of sellers, but only a handful of credible buyers who have the track record in Africa, the right relationships, and above ground expertise to get difficult transactions done. We're also seeing a pullback from some of the PE players who have been active in the recent past, which also reduces the likely buyer pool, as the equity financing that has been there in the past becomes more difficult. And so again, I think it's sort of a knock-on effect as companies and investors manage through this sort of ESG transition. But that combination of a few buyers and lots of sellers means we believe we can buy assets at attractive prices today. In terms of valuation, I think we think assets will trade below sort of their 1P PV10 valuations based at reasonable oil prices. where we think the new buyers can have access to significant upside through both sort of realizing the 2P potential resource base as well as through price. And so there's a lot of potential for value creation and appreciation that we'll continue to evaluate. But it is an evolving market and one where there looks to be currently a dislocation.
It's really interesting, Neil, especially on the comment on the 1P kind of like valuations you're seeing out there. So maybe probably we should be expecting a bit more activity from all these African players in the near future. Mr. Selassie, let's go back to Nigeria now. Now, Shell recently announced that it intends to exit onshore and shallow water Nigeria. And although NSPDC has been, reducing its footprint for quite some time, and actually Seplat was created out of those Shell assets, it is still a critical player for onshore Nigeria. And a lot of some stakeholders at least are a bit worried that the exit of such a big player like Shell might be a bit disruptive, at least maybe in the short term, for the sector. How do you plan on managing this? You're on mute.
Yes, indeed, the news of Shell's divestment came as a surprise to us because in the course of discussing the PIB, one of the they raised several concerns, and we thought most of their concerns were addressed in the final bill, and hearing their decision to still divest was quite a bit of a surprise to us. But having said that, we see in every disappointment, we see opportunities, emerging. So for the local space, we believe that the Nigerian oil and gas industry has matured to such a point that, yes, we can grow more internal capabilities and resources to run the oil and gas business. So in as much as it will be, like you put it, it may be destructive. I'm not saying for a certainty, it may be disruptive in the short term. I believe we are all geared for taking up the challenge very quickly and running with it. Nigeria is hopeful that we will get back to, especially with the very generous terms of the PIA, we are sure we can fill the void very quickly and work the oil and gas space appropriately, especially the onshore space.
Thank you so much for this, Mr. Selassie. Emeka, with this Shell announcement, how do you see the M&A space in Nigeria, and do you think there are opportunities for indigenous players there?
Certainly, I think the M&A space in oil and gas in Nigeria is beginning to get exciting, with the IOCs retreating from onshore and shallow waters into the deep offshore. You just talked about Shell announcement. We won't be surprised if we have other announcements coming in the market as well, because the market is expecting that. So I believe that the local indigenous players are poised to take advantage of that to increase their operations here in Nigeria, as well as attract some mid-sized IOCs into the country as well. Well, I think what is important is that these assets are sold to companies that see themselves as stewards of the natural resources of the country. That will be in a position to be able to continue to make the investment that is required, for the development of oil and gas assets in the country. Now you talk about relationships, you also have a good relationship with government. And for the onshore assets, relationship with the communities for them to continue to operate. We believe probably they could actually step up development of these assets, and at the end of the day, let's just be serious. I talked about to be an opportunity for the government as well to enhance production. We in Seplat, we see ourselves right behind IOCs in terms of volume of production today, also in terms of governance, operational efficiency, and financial capacity. We believe that we're in a very good position to to participate in this acquisition of this divested asset. We'll be looking at the opportunities to strengthen our upstream business and dominate and increase our dominance of the midstream oil and gas business, which we've seen that we're an active player in gas in this market and leading the energy transition in terms of gas production locally, while we also focused on renewables as the energy mix of the country, we believe keep changing over the next 20 to 30 years. So I think it's a good, we're excited. We're looking at with very keen interest on the opportunity that will come in that space in terms of divestment.
Thank you, Emeka. That's very clear. Let's talk now a bit about the energy transition in more detail. Mr. Seye-san, Nigeria is clearly very independent on oil for its prosperity, and I believe that up until recently there was this target of about 4 million barrels per day of output, which is about double, the pre kind of like OPEC cut levels. Now, in light of the shifting energy trends, and what is Nigeria's position on the energy transition, and do you still maintain those production targets?
So indeed, Nigeria is totally committed to the energy transition agenda, and we are also committed to net zero. But I think we need to also situate regional needs and regional developments with the plans that we all have. So as a nation, we have committed to increasing our renewable footprint, and we have embarked on quite some projects in the biofuel space, which we are still working on. We are also tinkering with solar, but I think we are also going to be paying quite some attention to carbon capture strategies. And on a go-forward basis, we see gas as a major transition fuel. The Minister of State says he doesn't see it as a transition fuel, but as a destination fuel. I agree with him to a large extent, but we see gas, we're endowed with the gas resources, and I believe that if we're able to utilize and reduce gas flaring, in the process, we will also institute efficiencies, in the production processes. So to summarize, we are committed to the transition. The program I earlier explained about where we are moving in the gas space is an attestation to the fact that gas will be a major player here, but we are also committed to other renewable sources of energy, and biofuels is a key alternative, as well as working on our carbon storage strategies.
Understand, but in general, when you look at when people think of oil production, the idea is still to grow that production, to continue and growing oil production, to effectively monetize the reserves, the ample reserves Nigeria has. Is that how you should be thinking of it?
Yes, I think that goes without saying. We need to still produce because, the demand is there. The switch has not yet occurred. Do we have the wherewithal to switch? Not in the short term. In the long term, of course, we're all working towards 2050. I believe we will get there, at least in the next 10 years. oil will still be relevant, but we will continue to ensure that we incorporate efficiencies into our utilization of our fossil fuels.
Understood. Very clear. Now let's talk a bit briefly about West Africa more broadly. Now, Neil, Cosmos and Tallow are responsible for many of Africa's major discoveries. But since the pandemic's outbreak, it looks like frontier exploration doesn't seem to be a priority anymore for investors' dollars. So how do you see Africa's exploration outlook?
Yeah, Nick. So I think in partly relating to the last question, I think to ensure sort of a just transition, we believe the nations across Africa should be allowed to prosper from industries such as energy that the developed world has depended on to drive its own prosperity. For Cosmos, we want to work with countries in Africa to provide the world the energy it needs today, but in the most cost-efficient and energy-efficient way. Africa has a huge amount of discovered resource, which has yet to be developed and monetized, and that's means of significant potential. Cosmos is focusing its exploration expertise on working with partners in country, to produce the barrels that have already been found, as well as develop new resource around existing infrastructure that has the highest chance of being, produced economically, over the next decade or so. And so, we did step back from frontier exploration in early 2020, due to the timelines involved and the acceleration of the terminal value, which basically increases the risk of generating a acceptable return for our investors. So I think that's a reality, that a lot of companies are, having to deal with. There are a handful of majors and independents who will continue to pursue frontier exploration, but most have put a time limit on how long they will continue to do that. So maybe for the next 2 or 3 years. But for Cosmos, given the exploration portfolio that we have, we do see a lot of opportunity, particularly in West Africa, Equatorial Guinea, the Gulf of Mexico, within our portfolio to grow production around existing infrastructure where the cycle times are shorter, and new production can be brought on sort of more economically and with less risk. It also has the benefit of a lower carbon intensity, given you're using existing infrastructure rather than building sort of new greenfield facilities. And so for us, that's the right strategy to continue to sort of grow and explore for the next several years, although people will have different time frames to get there.
Thanks. But Cosmos's exit, and when people think of Cosmos, they think of a company that is responsible for many of those discoveries. To me, it looks like if in Africa you are an established hydrocarbon province, then exploration will continue. But if you're that frontier, then this might not be the case. Is that how I should be thinking about this?
Yeah, like I said, I think there's some companies, who will continue to selectively invest, who've built portfolios in the past, who've matured prospects, invested in sort of the development of ideas, and will drill those prospects out over the next several years. And I think that you'll see sort of continue this year, next year, largely through maybe 24, 25. But I think, what's becoming harder and harder is to access new acreage, frontier acreage, and justify the risk reward of investment, because once you acquire the acreage, you have to shoot seismic, you've got to mature the opportunities before you can even drill it. It was sort of a three plus year time cycle to get to a drillable status, to get to the right risk reward for frontier exploration. And I think that's becoming a bit more challenging. So you are seeing the activity sort of cluster around where there's been recent success, and where the risk for success is a lot better.
Very clear, Neil. Thank you so much. Emeka, we're still on the same topic, energy transition. So it has already started putting some pressure on the MP model, the energy transition. And in your recent capital markets day, Seplat announced its intention to enter solar and off-grid gas to power. Now, do you think that the EMP model can remain viable in the next 20 or 30 years, or was this announcement more like a hedge against potential declining oil demand in the future?
Okay, I believe that the ERP model will still remain viable in the near future, with a complement of the right thinking and planning. Okay, in Seplat, we took a decision years back to make investment in gas production and processing, because we believe that gas will lead the energy transition here in Nigeria, particularly gas to power. Today we're supplying about the 30% of the GenCo requirement for gas. On our Capital Markets Day, we talked about our strategy going forward. We talked about the position of Seplat in terms of the transition and creation of our new energy division. This division will continue to extend our presence in the gas business and down the gas value chain. Currently, we sell our gas over the fence. Directionally, we would like to go towards gas to power. And given the rigidities you have in the power industry in Nigeria today, we're taking a view that we should do gas to power, backup for off-grid power. And that's the area of the direction we want to intervene in the power sector. We are also monitoring the changes in energy mix, particularly for the country. Some of the studies we commissioned, one of them particularly, came out with a report that the solar industry here in Nigeria, particularly in terms of supply of power to homes and commercial establishment, has a great potential. Talking about a growth of about 26% CAGR for the next 20 years. And the potential about $17 billion here in Nigeria alone. That report we are studying, and based on that report, we currently are looking at extending our presence in the renewable background in the solar renewables. We also recognize that we don't have the in-house capacity currently for the kind of skill set required for that sector. We believe that could be a play of manufacturing or retail distribution. So part of what we are doing currently is enhancing capacity internally to participate in that sector. We will, over the years, be making incremental capital allocation to that sector to ensure that we lead, not just in terms of gas transition, in terms of traditional energy in Nigeria, in terms of gas, but also participate in taking the opportunity in terms of changing energy mix here in Nigeria going forward.
Very clear, Emeka. Thank you so much for this. Neil, would you like to share your views, please, on the EMP model, if it can remain resilient based on the energy transition?
Yeah, Nick. Well, I mean, the EMP model is changing, and I think companies have to respond to the energy transition. Companies are choosing to respond in very different ways. Many companies are choosing to reduce investment in EMP, producing out their sort of reserve base, and then returning cash to shareholders. In the case of the majors, many are sort of investing in green energies to sort of transition their portfolios. This lack of investment in EMP, I think, will result in the best acreage being drilled first, with then production declining, given sort of the minimal investment in new projects. We've taken a differentiated approach at Cosmos, where we're investing to grow, particularly in Africa, where we see energy demand increasing as the population increases and living standards improve. And so, I think the model is being pressured and changed, but companies are handling it very differently. We're investing half our capital is within the gas assets in Mauritania, Senegal. As we talked about, we think gas is going to play a very important role in the energy transition as renewables ramp up, and higher carbon emitting fuels such as coal are phased out over time. On oil, we want to grow our lower cost, lower carbon oil portfolio investment with focus on sort of the infrastructure-led exploration. And we want to work with governments to accelerate economic and social progress in developing countries and bring them closer to the living standards that we're all accustomed to. And so there will be significant sort of change within the E&P model, but I think there's if the whole if there's a number of companies who are reducing their investment, there is room for those specific companies and countries to grow their production in a responsible way.
Thanks, Neil. That's quite clear. Let's talk about a similar but related theme. That's ESG. Emeka, anybody who has been following Seplat's story closely will have noticed that your corporate communication in general, Seplat as a company has been becoming a lot more like conscious on the energy transition and in general like ESG. And in a sector that is somewhat, out of favor with some ESG investors, can you please talk briefly about, what Seplat is doing to improve those ESG credentials? I think you already spoke a bit about, renewables and some of the gas, so I want to reiterate some of what you said already.
Okay, thank you, Nick. The major part of our greenhouse emission coming from gas flares. It's about 90% of that, and we are taking a decision, based making investment in gas flare projects, and by 2024 we are going to have a near gas flaring, and also for the power. Talked about the upgrade in terms of using the gas for power as well. Now, apart from that, internally as well, we believe that a major part of the electricity crisis in the country is the fact that diesel generators are used to generate most of the power that are used in Nigeria. And we believe our participation in the gas sector will replace the generators and reduce the carbon footprint coming out of utilization of this diesel generator. And that's a very major component of our contribution to reduction in terms of emissions. We always also pride ourselves on the social side of the ESG in terms of what we do with the communities. We've had a very robust program of community engagement, from health services to education services, and with the incremental allocation, coming out of the PIA as well, that will strengthen our position in terms of intervening in this sector, particularly on the social side, which we have done so well today in Nigeria. Beyond that, in terms of governance, we believe that we have the best-in-class governance in the country in terms of the quality of board and quality of operation. Will continue to enhance that governance going forward. That in a nutshell is what we're doing currently, and we'll be enhancing the reporting that you see in our report in terms of what we're doing on the ESG space generally. Thanks.
Thank you, Emeka. Neil, Cosmos announced to us Scope 1 and 2 net zero targets by 2030. That was long before any of your African E&P peers did, and I have to compliment you on being, I guess, ahead of the rest of the peers back then. Do you think that this will be the gold standard for E&Ps, going forward? And you could maybe elaborate a bit more on how you plan on achieving that target.
Yeah, sure. Thanks, Nick. Yeah, you're right. We did set a target for Scope 1 and 2 net zero by 2030 or sooner, and we are sort of actively and have been actively for the last sort of year and a half in pushing the agenda with our operators and partners to improve operational efficiency, reduce carbon emissions across the portfolio. And as I mentioned earlier, we're also investing in carbon capture projects in the areas in which we work, working to offset any emissions that we can't mitigate. Scope 1 and 2 has been sort of vocalized by lots of companies now over that last year and a half. But I think there is growing interest from our stakeholders around our Scope 3 emissions, and so we've been working with both internal and externally to better understand our Scope 3 footprint, and we believe this ultimately will be a requirement for a lot of companies in the industry from multiple stakeholders. And so I think we do want to ensure we're being proactive on that front. At present, there's still a lot of uncertainty around Scope 3 and who's responsible for what, particularly for sort of E&P companies. What part do producers, the midstream, refineries, consumers, retail sort of take part in that? And I think that will continue to be a discussion that plays out over several years. But I think at Cosmos, we want to continue to be proactive on the issue and work hard at it. I think firstly by just understanding the current emission status, what our Scope 3 is, measuring it, and then working with others across the industry to reduce and mitigate those emissions. And I think we're in a fortunate position as we have our portfolio, as we build gas, which has a lower emissions than oil, our Scope 3 emissions naturally come down over time as gas plays a larger piece within our portfolio. And so it's hard to say that there's not sort of definitive gold standard, but I think the bar, once you've achieved it, will continue to move higher, as it should, as we all sort of tackle the energy transition in a way that makes sense.
Thank you so much for this, Neil. I mean, what all our panelists seem to be in consensus is that gas is definitely, required for the energy transition and at least reducing the carbon footprint of countries. Now we only have a few minutes left, so as our discussion is coming to an end, I'd like to give a few minutes to each of our panelists to share their views on the outlook of West Africa oil and gas sector and Nigeria as well. Mrs. Seyesan, let's start with you.
Yeah. So thank you very much. Indeed. We started discussing about the PIA. This is a long-awaited milestone for us in Nigeria. The look forward for us is exciting. We think it's going to be a very, very exciting time for the oil and gas industry. We are committed to developing our resources for the betterment of Nigerians. And this is also geared towards addressing the 17 SDG goals as well. We need to eradicate poverty, and we have a major resource. We need to eradicate hunger. We have a major resource. We also need to address and provide affordable energy, for development as well. And we have a great resource. And I believe the PIA is a major enabler, to us utilizing these resources, hydrocarbon resources that we have, for the betterment of Nigerians. But having said that, we are also mindful that, yes, the global decarbonization drive is a commitment that we've also made, and we will work, and we are working to ensure that we push that agenda even domestically. Like Emeka said, even the mere conversion of the energy source from diesel generators to gas driven turbines is a major shift, in our carbon emission process, and I know we have much more, in the kitty in the years ahead. So we look forward to an exciting time. The PIA is a major enabler for us, and for NNPC. The whole transition to NNPC Limited, we believe is going to be a seamless process, and we are committed to achieving the objectives for which the NNPC Limited is to be set up on, and which is to be a commercial and profitable venture. We've started on that tangent, and our performance for 2020 was, like I said, a major testament to our resolve to achieving, this objective. We are also excited because we see a lot of appetite, in the domestic space for resourceful companies wanting to play actively in the gas space as well. And that is very encouraging. We are discussing with our indigenous partners and stakeholders on how we can expand and they can also participate in this space. So by and large, it's going to be an exciting time in the next couple of years. NNPC and its partners are all set to set this ball rolling. Thank you.
Thank you so much for these insightful comments. Emeka, floor is yours.
Yeah, I can't say better than Mr. Yesan has said. I think what an exciting time for the industry here in Nigeria. I think there's been a lot of focus on the PIA in terms of the physicals, but beyond the physical, that the whole architecture of the industry has changed in terms of governance, in terms of regulation. You can imagine our excitement to welcome an NNPC that will be driven commercially, so that they will be in a position to compete with other national oil companies. Or imagine our excitement to look at the prospect of independent funding of development of assets in terms of the IJV to be formed with our partners. We are also excited because the NNPC we see today will work very well with them, and they have so much focus on the success of the industry and so much commitment, of course, which are reflected in getting the PIA passed after so many years. Now, beyond the architecture of the industry, beyond the opportunity working with the government partner and welcoming the NNPC into the commercial space, also the M&A opportunities that are thrown up, the opportunity for indigenous companies to increase their footprint and participation in the industry. And with the energy transition and participation in gas particularly, we're going to see an industry that will have to expand their internal leakages rather than being externally linked as previously, like you've seen in terms of the crude oil and export of crude oil. So quite an exciting time. So I talked about also new skill sets in terms of chasing the energy mix in the country. If you're going to participate in renewables, you can see that you have to develop skill set beyond participating in the extractive industry. So it's quite an exciting time, and we're very happy, Seplat, to be well positioned to take advantage of opportunities that exist and are coming up in the industry. Thanks.
Thank you so much, Emeka. Neil, are you as excited as the other panelists about Western Africa oil and gas outlook?
In short, yes, Nick. I think I agree with a lot of what the other panelists said. I think the outlook for sort of oil and gas in West Africa is bright. We are at an inflection point within the industry where a lot of things are changing, and so the industry does need to be carefully managed, particularly as we go through this sort of inflection point. There's significant discovered resource in West Africa and future potential that we all need to be working together on. And so it requires governments and the right companies working collaboratively to ensure the resource is developed responsibly. I can say Cosmos is doing our part to grow production of low cost, low carbon oil and gas. And we think we can be a force for good, particularly in West Africa, as the industry goes through that transition. And so, while doing that, we believe we can create significant shareholder value as an independent company with a differentiated strategy and asset base. And so, I think the next few years will be particularly interesting, and Cosmos is excited to play its role within that space for West Africa.
Thank you so much, Neil, for those comments. I'd like to thank you all for your insightful comments today and for your participation to our panel. Now our discussion panel has now concluded. So once again, thank you so much, and I hope you enjoy the rest of your day.
Thank you, Nick. Well, thank you.
Thank you very much.
Yeah, appreciate it.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business. Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.
Good. Thank you all for joining this fireside chat with the MTN Nigeria CEO, Karl Toriola, as part of Renaissance Capital's 12th Annual Pan-Africa Conference. MTN Nigeria remains one of the more dominant, actually the dominant telecoms provider in Nigeria, with the #1 position and a market share above 50%. As of recent, it has a subscriber base that's quickly inching towards 80 million and many vertical platforms underneath. Whether it be the Ayuba messaging app, which had 1.4 million users as of Q1 2021, or its Momo platform that currently has 4.7 million subscribers. MTN is one of the strongest revenue generators in the Nigeria space across all corporates, and as of recently, is the official sponsor of the Nigeria Football Association. We thank Karl for joining us at this meeting, and what we'll try and do here is dissect and dimension MTN, where it is now, and what the outlook for the future is, whilst also talking through the vision as well as the views that Karl has gone through as he traversed various management positions across the MTN group. So I'll start with my first question, and that would be, Karl, you've held various management positions within the MTN group in different markets for over 15 years. What is common across African telecoms, and what differentiates these various markets?
Hi, Sam. Always nice to be with Renaissance Capital. You guys are friends of the house, and we see regularly, so it's a real pleasure to be part of your Pan-African Investor Conference, and thanks for the question. As you said, I've been with MTN Group plus minus 15 years, and worked particularly a lot in West Africa, but at some point in time, responsibility for opcos in the Middle East and rest of Africa, Zambia, etc., etc. So it's been a privilege and a blessing to get such a diversity of experience across the MTN Group, and has helped me in each step of my career. So what are the similarities? Look, in Africa, I think there's a theme of the youth wanting to be entrepreneurial, a strong entrepreneurial spirit amongst the youth, an expression of unique identity amongst the youth. I think that's one of the themes that you see generically across. Every country, every operation says we're special, we're extra challenging, but the truth is, to some extent, there's a lot of similarities in all the countries in terms of the challenge. Dependent on the litigation, regulation, and taxation systems and the sets of laws that are in each country, there are some variants. Some places have unique challenges. You'll see some places you have a 19% tax VAT rate. In Nigeria, it's a 7.5% VAT rate. Some countries and operating environments have different ways of encouraging investment into the country, and some are more technologically advanced and more liberal in terms of how private operators are allowed to develop infrastructure like fiber, etc., etc. But I'd focus more on the theme of commonality. We have a wide variety of cultures, but I think the identity of Africans in some ways are very similar. Africans, I am African, very warm people, very expressive. So you might mistake our expressiveness and our passion and screaming and shouting for aggression, but actually it's quite the contrary, very warm, loving people. And I enjoy working across Africa and miss some of the countries that I used to work in before. Thank you.
That's great to hear. And I think this issue of commonality, or this version of commonality, is what binds us and what makes MTN not just as specific markets, but as a group, a wholesome name, and why investors focus on it. I think if we were to drive down further into the current market in which you run, how would you characterize the Nigerian market in 2021? And we look at that from a perspective of competition, the regulatory environment, as well as technological advancement.
So look, let me just maybe also address some of the harder questions from an investor perspective, that from the previous question. Look, we have high youth, a large percentage of the population are youth. There's huge opportunities both in terms of data consumption, in terms of small, medium enterprises, and in terms of financial inclusion. So that's pretty much the generic across African countries, Nigeria inclusive. but maybe a wider runway in some countries than the other. In terms of how I'd characterize MTN Nigeria and Nigeria as a whole, it's very competitive. Look, we are number one. I don't like the use of the word dominant. I disagree, but we're number one in terms of market size by quite a gap. But it's a very, very intensive environment in terms of the competitive environment. The number two, I won't mention their name, are a good, strong professional organization. So it's by no means a free ride for MTN. And there's an intensification of competitiveness in a few spaces. In the last 8 months or so, we've been quite aggressive. We've put our foot on the pedal, and in terms of our capex investments, with a lot of focus on LT expansion. And we've now reached somewhere in the range of 65% of LT coverage of the population. But that says we still have another 35% to go to cover the country in terms of high-speed mobile broadband. We continue to compete very effectively. We're focused on competitiveness, not just in terms of technology leadership, data speeds, quality, but in terms of pricing within the regulations that we're allowed to follow. So it is our position that we must always remain competitive. We don't want to race to the bottom in terms of pricing, but we must always be perceived as being very competitive when you look at the mix of the services we offer, the quality of the service we offer, vis-a-vis our prices. The demand for digital services remains extremely strong. So we're accelerating the rollout of both capacity and coverage of our data network. And this is driven by lifestyle changes that come from the adoption of data. People consuming a lot more data, both for personal entertainment reasons, so the likes of Netflix, YouTube's, all the OTTs, WhatsApp video calls, etc., is driving this, but as well as looking for increased efficiency and productivity across all spaces of the economy. So we, as a standalone, are an integral part of the economic growth in Nigeria in the past 20 years, but we have also been a major catalyst. Banking applications, e-commerce, advertising, using all the OTTs, etc., have been enabled by the platform that we put in place. You mentioned 80 million subscribers. Actually, we're more around 70 million. The ban of new SIM registrations up until somewhere around May did affect all the operators in the country. Through that period, we believe we gained a bit of market share marginally. You'll see that in our half-year results. And now we've returned with the associate NIN registration to SIM, registering new subscribers. We're pretty much bottomed out in terms of the loss of subscribers. People who had lost their SIM cards, had churned, could not register because there was a ban. Now they can enroll for a NIN, National Identification Number. We have a license to do that. We're doing that for and on behalf of the government, and also get a SIM card consequently. So this impacted us. We resumed the sale of SIM cards somewhere late April, early May, and we're scaling up. We're still not at our peaks of our capacity to register SIM cards, but we're scaling up, and we expect the churn and the bottom out of the base effect to flush out in the next few months and start to rebuild our customer base. But as I've always said consistently, people saw the NIN registration and the SIM sales ban as a challenge, but I actually saw it as an opportunity. To do two things. One is to support the federal government in its drive to register the citizens of the country. But you see, if you issue a SIM card with a national identity number, which has been duly issued by the National Identity Management Commission, then you have zero risk of fines around SIM registration. So for us, it was an opportunity as well. And also, churn is very costly. The washing machine effect of people chasing promotions all over the place. Actually, you spend a lot of money just basically pouring SIM cards down the drain. So having a much cleaner base of subscribers who really want your services are less likely to churn is actually an upside for the industry. So seen as a challenge, but I think it's been an upside. But to recap, competitive market. We are focused on being competitive in terms of pricing, not a race to the bottom, but to remain competitive. Huge growth on data driven by COVID, Zoom, things like this, Microsoft Teams, and all those nice applications. personal data consumption, an increased number of people coming into the data world, so accelerating the number of active data subscribers. And we continue to play in the fintech space through our PSP, sorry, not our PSP, let me make that very clear, our super agent license.
Yes.
To develop a distribution network for financial services in the country, as well as a few other products. So we're optimistic about the future.
That's good to hear. Actually, as you speak, I see that if at all you have a NIN with a phone number that's MTN, when you move through the verticals, what you do have is a fully KYC client that can be utilized quite quickly and uploaded onto that stream. And you've talked about LTE and the fact you now cover 65% of the population. And I think the next step, as you look through global telecoms, is the move to 5G. When do you see MTN Nigeria starting a rollout of a commercial 5G network in the country? And do you think this will make a big change in the daily lives of consumers and the population at large?
So we're very much operating under the guidance of the regulators. The Honorable Minister of Communications and Digital Economy has expressed, and we have supported in full, his broadband plan for the country. And he has expressed his intention for 5G services to be licensed, as well as an auction for the spectrum around the 3500 megahertz band imminently. The stakeholder engagement process has been gone through by the ministry and the regulator. And we believe that the information memorandum for the auction of the spectrum, which we're interested in, and the authorization to launch, the auction and the authorization to launch 5G is relatively imminent. So the policy document, according to the Honorable Minister, is ready. The next step is the information memorandum, and then we'll be invited to hopefully participate in an auction for the spectrum, and subsequently launch will happen. When will the auction happen? It's not within our control. I must reiterate that and be clear that is firmly a regulatory process. But the regulator has been very supportive of this process. So we think probably the investment memorandum will be out October. Maybe an auction will happen somewhere between November, December, maybe January, and probably in the range of February. So we might, again, I cannot speak for government authorities, but we might be able to launch 5G. And we want to do it on a would I say, a decent scale. There are limited handsets of 5G handsets in the country. So you can't invest on nationwide coverage and generate no incremental revenue for incremental capital which you put on the ground. Our capital allocation priorities and process will make sure that whatever we invest can actually lead to an acceleration of our top line. So when it is finalized from a regulatory point of view, we'll go in, and we'll go in smartly, but as heavily as we reasonably can. So we maintain our leadership position, both in technology and in perception in mind of the customers. Where is the immediate business opportunity? Probably in the earlier days, it's in fixed wireless access for both corporates and residential consumption. But there are quite a number of other use cases around the world, which will eventually come to Nigeria. But certainly having those kind of data speeds on a wireless basis enables a lot of people to come quicker into the data space to increase their productivity and get all sorts of brilliant connectivity solutions. Thank you.
Thank you. And I think the other point we touched at the very start of this was around fintech. Fintech is very important to the MTN group, and particularly Nigeria, given the population, given the advancements, and given the wholehearted exploration, but also uptake by many parts of the population. MTN Nigeria currently has 4.7 million MoMo users, so mobile money users, 450,000 agents as of Q1, and the ambition is to have that to become 40 million users by 2025. This target could be seen as ambitious. I think is within the realm of reality, and it'd be interesting to understand your thoughts about the necessary steps to achieve that.
So, I mean, the current licensing regime that we have offers us, we hold a super agent license. So we don't hold customer wallets under the current regime. The primary focus, while we continue to develop our agent network and use that for a variety of transactions, our primary thrust of our strategy around fintech to really get scale in the business is the acquisition of a PSP license. We have not been that successful with that in earlier years, but we believe that as part of my top priorities, to fix some of the basic problems around stakeholder management in Nigeria, we've been investing a lot in stakeholder relationship building in Nigeria. And part of that is, of course, relationship building with all arms of the government, including the Central Bank of Nigeria. Some of those programs which we've gone through is our road infrastructure tax credit scheme, where we actually build a road, but we actually get most of those, pretty much all of those funds back from, in terms of tax credits. But it helps the Nigerian government with acceleration of infrastructure rollout. So we committed to a Enugu-Onitsha expressway refurbishment. That's probably the most important road in the east of the country. I think we've done that in a very positive and constructive manner with two ministries, the Ministry of Finance and the Ministry of Works. And that's one example. We've recently committed to sponsoring the Nigerian Football Federation. Football is in the hearts of all Nigerians and all Africans, as you all know. We have committed to demonstrate our further commitment to a long-term future in Nigeria. We've committed to the construction of a state-of-the-art green head office here. And that program is probably going to take 4 years, maybe even more. The message we're sending, and this is all going to connect back to fintech, the message we're sending is we're Nigerian. We're here to stay. We want to be an integral part of this community. We want to support the advancement of Nigeria. And it's a direct, but also a sublime message, which really should start to stabilize some of the stakeholder and government relationships that we've had challenges with in the past, and they enable us to unlock some of the opportunities such as fintech. Now, I have said this consistently, the decision on whether or not to give us a PSP is 100% firmly in the hands of the Central Bank of Nigeria. And we can't blackmail, wish it will happen. They have to be optimistic and positive about our contribution to this country and financial inclusion to open some of those blockages that we've had in the past. But we've been engaging repeatedly and really talking about how we can contribute towards financial inclusion. And we think in due time, I can't predict when, but in due time, we might be able to unlock this opportunity. So the 40 million is based on a PSP license, which allows us to hold and develop wallets in the country, specifically focused on people who are not financially included. So it's more of the bottom of the pyramid, and rather than threaten the traditional banking industry, it actually accelerates it. And we have lots of countries where we've seen that happen. And effectively, our assumption is over a few years, 3-4 years, we'll have 50% of our base actively transacting on mobile money. And that's where you see that 40 million subscriber come to play. So watch this space. We'll continue our efforts in stakeholder relationship building. But in parallel, there are other verticals within the fintech space, part of which is the super agent license, which we have. Building a distribution network within the fintech space. There's B2B businesses, which we continue to explore to ensure that we are not just blindly stuck on one strategic path, but looking at multiple routes to really get into the fintech vertical. Thank you.
Thank you for that. And there are two questions that pop up from there. And the first one perhaps is a bit more around the view of mobile money. And we've seen certain entities spin off mobile money from their telecoms business. There is a point of view that the Momo business is deeply integrated in telco operations, thus cannot be standalone. But there's also the alternative view that perhaps standing alone, like with many things, enables it run quicker and be more successful. What is the main idea from your perspective on the separation of Momo? And do you think that's something that that would work for the Nigerian market and perhaps even across the MTN group?
So one of the reasons that telcos have been the most successful in terms of financial inclusion, particularly at the bottom of the pyramid, is two things. One, customer relationships and information. Two, a very strong distribution network for airtime, which is leveraged up. Almost always the largest distribution networks in the country. And three is the ability to invest on a sustained long-term scale, educating and registering people for mobile money services up until the point where it becomes intuitive and widely accepted. And that is why mobile operators have consistently been the ones to really accelerate this. Does it need to be standalone? Does it need to be integrated? I think having a mobile network operator in terms of having a partnership where you can leverage off those strengths is critical to the success. On one hand, on the other hand, the transparency of the value of a fintech business and the multiples of valuation of a fintech business are such that sometimes when you bury them under the core business of a telco, people like yourselves actually don't see the value that's created. And on the third aspect I want to talk about is, regardless, at some point in time, to ensure that everyone has a playing field, the relationships between the mobile money businesses, be they integrated, and the telco, be they integrated or separate, have to be done on a fair value arm's length basis. Yeah. So there's multiple reasons to separate. One of them is the transparency of the valuation of the businesses. The second is to ensure that you have proper governance, and there are different governance requirements if you're working in a financial industry, financial services business from a telco business. So you want to ensure that you have the right board of directors, you have the right managers with the requisite prudential skills, risk management skills, anti-money laundering, all of those things. So that gives another reason to separate it, to create a different set of competencies which may be a bit lost within a telco business. And to also open the space up for various types of partnerships and potentially investors who can come into this business and work with us to really accelerate the overall expansion of the space.
Thank you. And then you mentioned partnerships there. And as you look through partnerships, yes, we mentioned earlier on this call that there's been intense competition, whether it be from telcos itself, whether it be from the banks, and also from independent fintechs who seem to be raising large amounts of money from mostly from external sources, but also from internal sources as we move forward. How do you expect that landscape to evolve from that perspective? Is it one or multiple partnerships? Is it one of MTN essentially becoming an API play? Because you do have this 70 million plus investors that are essentially KYC'd. And you are able to leverage off that.
Yeah, look, it's going to be an intense space, but there are many different sectors and segments of that space. And I think where our opportunity lies is really on the unbanked. A lot of the fintech solutions that are garnishing such big valuations, while they have helped and accelerated financial inclusion, still remain focused on the well-educated, financially savvy, already transacting, already banked customers. Mm-hmm. The opportunity where you really need a telco for financial inclusion is really at the bottom of the pyramid. And for the reason which I enumerated on earlier on, the scale of investment you need to get that kind of ecosystem up to scale. Distribution in remote villages in Damaturu and Ogwachuku and Tonkere in Osun State. Those kind of skills are not things that are covered by what we see now as the booming fintech industry. So I think there's still a huge opportunity, particularly for mobile operators. I think the depository money banks haven't been able to tap into that opportunity. I think the new fintechs are tapping into a lot of transaction velocity, but those are really for the already banked. And it's going to change. Look, I can give you a set of predictions, and in 6 months, they're completely irrelevant. But part of what we're also doing in MTN is to build a culture of agility that allows us to adapt. But that space of the real unbanked still remains a bit of a blue ocean where we can really get going and really assist and support the country with financial inclusion. Does that answer the question you were asking?
Yes, it does. Yes, it does. And whilst we're on that, one thing I wanted to go before talking around your being at the forefront of tower infrastructure is just to understand the plans for Ayuba. That's been widely successful since its launch. And I wanted to understand your vision for that in Nigeria.
Look, the biggest valuation creation in a lot of the capital markets and in the technology world has been around platform businesses. And Ayuba has started as a communications app, but over time will grow to be an app that serves a lot more and integrates a lot of the other things that we do in MTN. So it's a communications app to evolve into a customer services and self-service app, purchasing app. At some point in time, we'll have potentially layers of m-commerce on there and integrate it into our whole fintech world. So we started off leveraging what our strength is, which is connecting people and using that as an app which you can use to respond to the various OTTs and start to build some scale and a lot of interaction interfaces with customers. But over time, it's going to evolve into a lot more than that. You understand?
Yes, understood.
Clear? Sometimes I answer the question, I'm not quite sure if I hit the response responded to specific question that you asked.
No, you've answered it in a holistic way, which captures what is required in there. And then we'll move on to tower infrastructure. MTN Nigeria has been at the forefront of tower infrastructure outsourcing across Africa and in Nigeria. Many of the independent tower companies have done transactions with yourselves, and Nigeria is not just a benchmark for African telcos, but it's also proof there's efficiency in that independent tower co model. What were the reasons for this, and how do you see that part of the business advancing moving forward?
So there were multiple reasons, and I'm not sure in which order you can take the priority, but first is our core business was going to evolve. And we needed to focus on the service layer associated with telecommunications rather than the infrastructure, real estate, power part of it. It was taking up a huge amount of resources, both human and financial, to manage everything associated with owning towers across Nigeria. So it was a better business model, and over a long-term basis, you see clearly that your network performance in terms of availability improves when you outsource this to a company like ATC, IHS, whoever it may be, that all they do is focus on that all day. So that's one reason. And we've seen the results of that. Our uptime is a lot better than it was when we used to self-manage these assets. The second thing is it's a real estate asset. And the more occupancy you have, it's like having a hotel. And if you have 50% occupancy, there's a minimum cost which you're going to pay. And if you have 100% occupancy, you're going to cream off the upside. So it was a way of us being able to move an asset which was serving only us into a structure where it could be monetized to multiple operators a lot more effectively, because MTN, that not being its core business, was not very good at adding additional tenants onto our towers and taking advantage of the real estate assets portfolio that we had built up. So that was another reason. And then depending on country by country, the structure, there was also a good capture of value or realization of value in the sale of some of those assets where there was a large cash transaction. If you look at Nigeria and the currency devaluation, doing it at the time that we did, in hindsight, was actually a very good thing. For us, there was quite a considerable amount of value that was created through that. And yeah, so those are the reasons why we've driven in that direction. We will always continue to optimize our business model. So if there are things that we see that are not core to the services that we're providing today or we will be providing in 5 years' time, if there's ways we can do two things: one, move those kind of activities or assets to partners who can do it better than us, while capturing some of the upsides that might come from what I use as an example, multiple tenancies, etc. And the same for fiber, it could be the same for telcos. We will explore those. I'm not saying we're committed to any specific line, but we'll continue to look at that and evolve our business models as it goes along.
Thank you. And I think we have captured many of the key parts around the MTN business, whether it's growth, outlook, regulatory, competitive landscape. And I wanted to find out whether there were any parts that investors should be looking at as they invest in MTN's equity, or as they look through MTN's various debt transactions. What should the focus be? What can they hold you to as they look forward to MTN's performance in the next 6 to 12 months?
Look, 6 to 12 months is quite a short time to hold any leadership team to. But I would talk broadly about what our priorities are. If you look back at MTN Group and MTN Nigeria, we've suffered extensively from significant shocks to the system as a result of regulatory challenges. Some of those were partial own goals. Some people could perceive we were treated a little bit harshly. And a lot of those were because we were not extremely effective at stakeholder relationship management. And so when I resumed on this job, I had a few priorities. One was stakeholder relationship rebuilding. So I've spent probably an inordinate amount of time on external stakeholders, on communicating to the stakeholder environment, to the press, to government officials, to rebuild those relationships and reposition MTN as a humble company, one that is really willing to invest on a long-term basis in the advancement of Nigeria, and a Nigerian identity. And I've done that for 6 months. There's a theme that's going to continue. My face might not be as much in front of it. I'd rather pull back a little and let some of my other executives lead that story. And we have to execute on the projects where I spoke about, the RITC, the head office. And there's a lot more. I'm just talking about the big headline ones. And I think we've seen some dividends in terms of a stable operating environment, minimal shocks. That's one. The resilience of our balance sheet, the nature of our debt profile. You would have heard about our upgrade on our ratings. That leads us to borrow at a lower cost. And particularly as interest rates and inflation starts to rise in Nigeria, we have a fixed long-term view on our cost of debt, which we're continuing to explore further, and ways we can really fix the cost of debt and be slightly resilient to the interest rates going up. So that's the structure of the balance sheet, the structure of our debt, etc. Stakeholder management, a risk rating, debt structure. Then there's a return to competitiveness, to leadership, not just in absolute numbers, but leadership in the market. And that is reflected by our acceleration of our 4G rollout. It's gone from 60%, probably sub 60 to 65% in the first 6 months of the year. We'll continue to do that in an aggressive manner. And while keeping a very close eye on our Forex US dollar debt profile, we will be quite aggressive in the CapEx framework as we can reasonably, while keeping our commitments on dividends and so on and so forth. So there's a return to competitiveness, which we've done really well. I mean, it doesn't put it down, but I think there's a lot more that we can unlock by really accelerating things like LTE rollout, et cetera, et cetera. I'm very much focused on the culture of the organization, and really having an agility in the organization in place to cater for the rapid change of the environment in which we operate in. Things are going to change all the time, and we must have the agility to transform rapidly. We must have true leadership, not just of skill, but in terms of our mindset, our ability to respond to the market, how we are perceived in the hearts and minds of customers. So that's the critical aspect. So cultural transformation of MTN Nigeria is probably what I obsess about the most now, especially since we've sort of gotten the oil tanker moving on stakeholder relationships. I obsess about that incredibly much, because the strategies, I mean, you guys are all very well educated people, but your strategy evolves so fast. The most important thing is to have the agility and the culture to be able to adapt yourself. Then there's a big focus on efficiency as well. At the scale that we operate in, we must have the upside of efficiency on our side. There are some structural issues which are not that easy to change, but I see that as a challenge, not a problem. And there are other ways where we can find efficiencies within the organization. And then new vertical spaces, new or accelerating existing verticals, fintech, home broadband, digital, which includes the whole IOVA space as well. Our opportunities and white spaces or blue ocean spaces where we can really get into on a large scale. So we see the business is continuing to do well. 6 to 12 months to assess how well we've changed is probably a little too short. I think 24 months after my resumption, I think you can take a snapshot and see what it takes, because a lot of the numbers will still be within the noise, within accelerated investment, etc. But in 24 months, I think you'll see the results. The best way I can express what you said is I personally leverage myself to buy shares in MTN Nigeria. I wouldn't do this and pay interest, which is not cheap in Nigeria, if I didn't believe there was a significant upside to this business. And so take that as you may, but that's my personal belief, and I put my money where my mouth is.
That's good to hear. And I think the share price performance over the last 12 months have essentially proven this. And I think the market is reading it as a new step, and all of the initiatives you've mentioned are clearly being taken as being positive. So I think on that note, thank you very much for your time. Ladies and gentlemen, you've heard the strategy around MTN Nigeria and the path for growth as we move forward. Thank you once again for joining, and we look forward to engaging soon.
Thank you, Sam, and everyone else who organized this, and to all the people who joined. Thank you very much.
Knowledge is information, but not all information turns into knowledge. Today, every company leaves digital footprints in hundreds of different sources. But this information by itself does not tell you who it is you're looking at and what the risks of doing business with them are. Businesses can't exist in a vacuum. They need employees, customers, partners, contractors, investors. Good counteragents help a company succeed, create products, make profit, expand business opportunities. But what about bad ones? 49% of organizations around the world say that they've been victims of fraud or economic crime. 2/3 of Russian companies say they've encountered economic crime in the past 2 years. This is significantly higher than the global average. Every year, 15% of companies simply disappear, whether on their own initiative or because they're forced to do so by tax bodies, often leaving unpaid debts. If you want to minimize your risk, you need to find and analyze every scrap of information you can, identifying, analyzing, collecting facts. Processing big data is impossible without qualified specialists, experience, time, expensive equipment, new technology, machine learning, graphs. Spark Interfax gathers information from all available sources and converts it into knowledge, allowing you to see the world of business in its entirety with all its risks and opportunities. And there's no doubt that tomorrow we'll be able to understand the world of business even better, thanks to the emerging digital economy, cutting-edge technology, and the availability of new information about the lives of companies. Knowledge decreases risks and creates trust, the foundation of any successful business.